Good morning, everybody. This is Tyler Finlinson with Soltis Investment Advisors. We are just going to maybe give people a minute or two. We've got a lot of you that have joined already this morning, and we're excited to get going. We'll take just another minute or two just to let people get on and get logged in. We'll go through a couple of housekeeping items, and then we'll begin to move through our agenda and get to our speakers today. Okay, good morning, everyone. I hope everybody can hear me. I'm going to ask Kim, audio-wise, I can see you, Kim. Audio good and clear? Excellent. We're excited to take some time. We appreciate all of you joining us this morning. As we've said throughout the last many months, we feel bad that we're not able to be together in person, but circumstances as they are, thankfully technology allows us to still get a chance to be together and take some time to continue to fulfill our fiduciary responsibilities and go through some training today. We're excited. We've got some great things lined up today that we'll go through. We'll go through the agenda here in just a minute, we appreciate some speakers and things that we have joining us today. A couple of these: Andrew Kuhn from T. Rowe Price. Well, let me just go through the agenda. We're going to start off real quick with a recap on numerous regulatory and legislative changes that have happened this year. I know for many of you, we've spent time there, but there are things as we get to the end of 2020 that need to happen. And so we want to make sure and go through and provide some detail there. We'll then turn the time over to Kim Anderson, our president and CEO, and Kim's going to take some time on, there's a lot of innovation that's happening in our industry and continues to happen, and kind of handling that, looking at that innovation and also measuring it with prudence and process from a fiduciary standpoint. We're then going to turn the time over to Bill Wallace, our Chief Investment Officer. And Bill will take a few minutes and then introduce Andrew Kuhn, who's a Vice President with T. Rowe Price and helps oversee the target date funds from T. Rowe Price. We're excited to have Andrew join us. He had planned to come join us in the spring in our conference until, of course, we had to cancel that. So we're appreciative of Andrew being on today and taking time. He's going to go more in depth with some of the changes and some of the enhancements that T. Rowe Price is making to those portfolios. I know many of you are in those portfolios, and many of you have a target date solution in the plan, and we'll go through a good update there. And then we're excited to have Dr. Elliot Eisenberg, who's an economist and a nationally published and well-known economist, that will be joining us at the end. Dr. Eisenberg will talk about where the economy sits today. He'll, of course, touch on the election and what that may mean, and kind of everything else that they continue to look at. So we're excited to have him join us. He was also one of our keynote speakers we had lined up in the spring, and we're appreciative of his willingness to join us today as well. Tucker, if you'll go to just the next page, just by way of a couple of housekeeping items for today. We will be recording this training. So I know that obviously many of you are on. If you have other committee members that were trying to join today but could not, we will record this session like we have in the past. It takes us a few days to record it and get the file ready, and then we have to, of course, get it through compliance. So within about the next week, you should anticipate an email from us with the link to that recording that you can share, or if you're not able to attend the full meeting today, again, or others on your committee that would like to join. For those of you that are in need of CPE credits, those will be available from today's training. For those of you that are looking for those, just reach out, email Tucker Morin at Soltis on our team. I've listed Tucker's email address there. For those of you that may be on the phone and not able to see it, it's just tucker@soltisadvisors.com. And if you'll send an email to him, he'll collect your names, and then we go ahead and submit. We submit for you the CPE credits that will be available from today's training. The second thing is everyone is on mute. We've got a large crowd today that will be attending. So as you come into the meeting, you'll automatically be put on mute. We've done that just to try and help minimize any background noise. And I know that many of you or many of us are still working remote and those type of things. So we do want to have this be interactive today. So there's a couple of different ways in which we would encourage you to ask questions as we go. We're going to try with each session to leave a little bit of time for questions and answers. And so there's a couple of ways to do that. One is you'll notice on your screen, if you're logged on online, at the bottom, you'll see a Q&A icon. You can simply click on that, and at any time throughout the session, put in a question, and then we'll do our very best to get to those. The benefit of submitting it online there is if we're not able to, because of the amount of questions or whatnot, if we're not able to get to them, Soltis will gather those questions. Those that were unanswered in this training, we'll take the time to reach back out to you and try and make sure that we get an answer to you. So if you, that's probably the most efficient way to submit a question for us today. And again, we'll do our very best to get to as many of those as we can as we get through each session. The second one is there's a raise hand icon also at the bottom of your screen. You can simply click on that. And what happens then is it will come to us, and we'll kind of open that up. Like I said, if we can with each presenter, have a few minutes for Q&A, and you'll be able, at that point, you can raise your hand. At that point, we can then unmute you, and it will put you on screen if you want to be, or we'll just unmute you so that you can ask the question, and then we can, of course, have presenters respond. So we'll do our very best. Again, we want to make sure that we can participate as if we were there in person, so please don't hesitate to submit questions either way, and we look forward to trying to make sure that we get to all of those. I'm going to go ahead and we're going to move into our first session here. Perfect. Thank you, Tucker. I'm going to try and take over here so I can. Tucker, if you can go ahead and end your sharing, and then I can go ahead and start mine. Thank you. You should be able to see what's next. 401k regulations for 2021. This year has been regulatory changes. They don't come all that frequently in this world, but in the last, I'd say 18 months, we've had a wave of them come, and of course, they were significant pieces of legislation with some pretty significant changes. I know that we've spent a lot of time over the last 12 months trying to keep up on these and explain them and educate our plan fiduciaries on them. We want to take a few minutes today. I'm going to take just a few minutes today and go through. I don't want to take too much time to go through and explain the regulations because I think most of you are familiar with them and aware of them. What we want to focus on today is there are action items for most of us that need to happen or you need to be aware of as we get into 2021. And so we're going to take some time going through each of those and taking a look at those. So 2020 was a year of new things, and legislation was certainly not the exception. We had the Secure Act that was in Congress at this time last year, got passed just at the end of 2019, and that had a lot of significant legislative changes that came to fruition with that law. We then, of course, as we hit the March timeframe and the COVID pandemic that hit, we quickly had a CARES Act that was passed that had a number of legislative changes as well for 401k participants and plans, and we'll go through those. And then in June, we had electronic disclosure that also hit us in terms of a new ruling from the Department of Labor. And then forgive me for, we even just had in the last couple of days, the Department of Labor coming out with a final rule on what's called ESG investments. And while that ruling is just fresh, we do have some detail. We'll take a little bit of time on that today, and then we'll spend a little bit more time in the coming months with you all on those. So let's jump in. I'm going to start with the CARES Act. And I think the important thing for plan sponsors to be aware of right now is that these provisions, this act was put in place. Most of the provisions from the CARE Act were put in place, and they're set to expire at the end of the year or in the latter half of the year. And so I just want to go through each of those quickly and make sure that we're aware of those that are going to expire or those that already have, and what needs to happen if any action needs to be taken as those do. So the first is under the CARES Act, one of the provisions was that it allowed participants to increase the amounts that they could take in a loan from their 401k account if they had been impacted by COVID. It also allowed them to defer if they had an existing loan that they had already taken and COVID was impacting them negatively. They could go ahead and defer those loan payments for the remainder of the year. Now, for those that this law, the CARES Act went into effect on March 27th of this year. The loan increase amounts, those applications, they were allowed to happen for 180 days. So participants that needed to take a loan, they were able to do that. That has since expired. It expired on 9/23 of 2020. So if a participant's looking to still take a loan, that of course has expired. They're no longer able to do that. Now, loan repayments, for those that maybe had an existing loan and they could defer that payment, that delayed payment period began on March 27th. That goes through the end of the year. So those that have delayed those payments, they'll be able to delay those until the end of the year, at which time beginning next year, those payments will need to resume. I think most participants were notified with, if they did apply for those, for that relief, that the interest would continue to accrue. And so what will likely happen for those participants is beginning next year, their payments will resume and the accrued interest will be reamortized, which means the loan payment that they had before they suspended it is likely to change just a little bit. I say likely because this is one of the areas that was a little bit gray. Each provider was looking at it a little bit differently. Some providers didn't even actually go forward and offer the loan option because of some of the kind of the gray area from the Department of Labor on how to reamortize those loans and how the interest accrues, et cetera. So, but just for, I think members of this group know that those payments are expected to resume and that more than likely the interest that accrued will be reamortized. And again, those participants will likely see a little bit higher payment because of that as those loan payments resume in 2021. The last one here, and this one's pretty minimal, student loans. For those that, not all companies offer this, but for those that have tuition reimbursement where they're able to do that, participants were also able to take those tuition reimbursement and apply that toward loans, and or they could do deferral of those payments, which also expired on 9/30. So that's a much smaller group in terms of what happens there. But for those of you that are doing that, you're probably aware of it and know that those that tuition reimbursement is there, and that those payments can be done through the end of the year, and then the deferral ended on 9/30 of this year. So with the CARES Act, the loan portion was a portion of it. Distributions was the largest. So this is where most plans that adopted the CARES Act provision, or all of the provisions, most adopted the distribution provision. This is pretty straightforward. It again, it allowed participants to take a distribution from their account, a maximum of up to $100,000 or 100% of their vested balance. They were allowed to do that. They're still allowed to do that if they were negatively impacted by COVID. That distribution provision is set to expire at the end of this year as well. Okay, so from now until the end of the year, participants are still eligible to take those distributions. Again, that expires on December 31st. As they take those distributions, when they do so, they have an option they can repay that distribution back over a 3-year period. And there's some tax benefit to doing that. Of course, they make that choice. A participant makes that choice at the time that they take the distribution, and they make that arrangement with your record keepers. And so, of course, those repayment options for those that may have taken a distribution this year, if they put a 3-year repayment option in place, those will stay in place and continue to happen, obviously, for the next 3 years. Participants, again, just as a quick reminder, most of you, have probably seen or had very little involvement here. That's a positive. Participants, there's no verification from the plan sponsor that has to happen. Participants simply self-verify directly with the record keeper, so that as a plan sponsor, you're not involved. And the record keepers kind of go through that, and it's the verification process is the responsibility of the participant, whether or not they meet that criteria. So one of the questions that we've gotten a lot here recently is there talk about extending this? Obviously, we're not beyond the COVID-19 pandemic, and will Congress extend some of these provisions? There really hasn't been, this is probably not a surprise based on all that's going on in the political world, but there hasn't been much talk about that, but it certainly could happen. Our expectation or our anticipation is if Congress decided to extend some of these, that they would likely do like they did this year, and they would make them optional. In other words, when the CARES Act was passed, these provisions, they were optional. You did not have to adopt them into your plan, but you had the option to do so. So our expectation is if Congress at some point determines to extend these provisions into 2021, they would likely be optional as well. But of course, we'll kind of wait and see how that comes. The last element of the CARES Act, just in terms of expiring, is again, many of you know, but required minimum distributions, they were waived under the CARES Act for 2020. Again, we've talked about this, but typically a required minimum distribution is done automatically by the record keeper. So if a participant, is over the age and they have to take them, they just automatically, if the participant doesn't actually request it, the record keeper will go in, automatically calculate and distribute out the minimum amount that they're required to take. For 2020, not all record keepers are the same, but all of the record keepers that we have talked with, all of them are waiving that automatic. So in other words, if a participant is expecting an RMD this year, and where they normally get it because it's automatically done, the likelihood is they will not receive it unless they actually request it because of the CARES Act. So again, we want to, I think just something to be aware of if you have participants that, maybe look and saying, hey, I normally get this check this time of year, I'm not getting it this year. The reason would be is because of the CARES Act. It's not automatic, and that will be waived. And again, that waiver expires at the end of the year as well. So beginning in 2021, those RMDs will again be calculated. Now, one last thing with the RMDs is for those that may have taken them earlier in the year before CARES Act was passed, they did give these participants in the law the ability to roll. If they didn't need those funds and they'd already taken them, they had a 60-day period, or no later than August 31st, they could have rolled those back into the plan or to a qualified account where they wouldn't have had to pay any tax. If they were to take an RMD today, they would have 60 days or till the end of the year basically to roll that back in if they decided they didn't need it. And so again, those are provisions that will expire as we get to the year end as we go through it. Now, one thing is obviously these provisions were put in plans, they were made available immediately. Part of the act was to not put the responsibility on the plans to have their plan documents amended immediately. So the IRS has been quite lenient. They've given you a fair amount of time. For those of you that adopted these provisions, your plan will have to be amended at some point to to reflect those changes. But the deadline is basically not until the end of 2022. So on the IRS website, in legalese terms, it's the amendment deadline is the last day of the first plan year, beginning on or after January 1st, 22. For those of you like me that are not attorneys, that just means December 31st, 2022. So, and what will happen is as we get to that time frame, really your record keepers, for many of you where the record keeper has a prototype plan document that they've helped you with, they will be coming to you with, to make sure those amendments get put in place. But again, from a timing standpoint, many of these provisions expire at the end of the year. However, it won't be until, another year or two where the plan amendment will actually have to be intact. Okay, so that covers the CARES Act and some of those provisions that are expiring. The Secure Act that was passed last year also had some pretty significant changes to the retirement plan world for ERISA governed plans. It was signed into law back on December 20th of last year, and it had some purposes to that. With the Secure Act, many of these provisions basically become effective as of January 1st, so they become available. I wanted to make sure today that we help educate you on some of the provisions that the Secure Act put in place. They're mandatory. In other words, as a plan, you have to adopt them. And some of them are optional. And so we just want to make sure you're aware of which ones are mandatory, which ones are optional. Many of you, your record keepers, are reaching out to you right now, or they will be if they haven't already, to kind of help you begin to look at these and make a determination on the adoption for those that are mandatory and those that are optional. But let me just go through these. So one is RMDs. Mandatory change coming in 2021 is that the RMD age will increase from 70 and a half up to 72. So that's a mandatory change that will happen going forward in 2021. After death stretch RMDs, there's a change there as to the timeline that a beneficiary has to take those. We'll touch on those in just a minute. Another mandatory element is eligibility of part-time employees. So for those of you that have part-time employees, beginning in 2021, you have to begin counting or calculating and allowing and getting ready for part-time employees to be allowed to participate in your plan. There's also lifetime income illustrations. That is a requirement that's part of this law. Now, this one will really fall on the record keepers. They're working to, when they send statements out to your participants, that they'll have a lifetime income illustration that will be included. And then lifetime income portability is another requirement of this law. And that is if you've got a lifetime annuity type of product, that it has to be portable, so that if a participant's in the plan and decides to leave or transfer out or move to another plan, that they'll be able to take that product and or that option with them. Now on the optional side, you'll see here part-time employees are, and the optional part is it's optional on how you match for them and how you include them in your testing. So this one's a little bit tricky. Under the law, you have to allow, if you have part-time employees, you have to begin to allow them to accrue time to participate in your plan. However, you don't have to match them at the same level that you match everyone else, and you don't have to include them in your testing if you don't want to. And so this is important, part of the law. What they're trying to do here is make sure that you're not going to get penalized by including part-time employees that normally wouldn't be contributing maybe nearly as much or as participating as high levels as your full-time employees. And therefore, the law doesn't want to, Congress doesn't want to punish plans for making part-time employees available. And so you can opt out of whether you want to have them, in other words, you can say, we're going to have these employees, they're eligible for the plan, but we're going to match them at a lower rate or not match them at all, and or we can take them out of the testing. Birth and adoption distributions, those are optional. They're available to be put in place in a plan beginning in 2021. Again, real quick on this is that it allows participants to access and take up to $5,000 out of their account for birth or for adoption expenses that they may incur. Again, optional that you can do. Auto escalation cap also ready to go into effect January 2021. Previously, until now, you could auto escalate somebody up to 10%, but you have to cap it at that point. You can't auto increase them beyond that. This law changes that and allows you to go up to 15. So for those of you that have auto escalation or are considering it and you have a 10% cap, beginning this next year, you'll be able to have the choice that you can increase that up to 15 if you would like. And then in-service distributions, they've lowered the minimum age for certain plans, 457 and government plans, in doing that. And again, that applies to just a few of you, but we're happy to take more detail there. The next two pages here, they just kind of give you some additional details on each one of these in terms of kind of the effective date, considerations that you need to be making as a plan sponsor. And we're happy as we have this recorded, we'll send this out so you'll have this information with you. But again, you should be expecting, if you haven't heard from your record keepers already, you will be hearing from them in the coming weeks as they, are going to be looking from a directive from each of the plan sponsors on getting these things put in their plans and which things, those that are mandatory as well as those that are optional. So which one of those requires a plan amendment? If you're doing the increased auto enrollment safe harbor, that will require an amendment. Pooled employer plans, simplification of safe harbor, the child adoption, the acceleration of the post-death RMD, portability, long-time or part-time workers, and then of course increasing the age for required. So all of those elements, all of those, some of those are mandatory, some of those are not. They will require amendments to your plan to make sure those are included. Now, similar to the CARES Act, the Department of Labor, they're trying to be somewhat lenient in giving you time to get those in place. So those amendments don't have to be done and ready by the end of the year, but in the next year, your record keepers again will be kind of working with you to help you figure out, how to adopt the mandatory ones, which ones are the optional that you want to adopt, and then of course, which ones that and then work with you on amendments to your plan. Those amendments will for the most part need to be put in place by the end of next year. So I think what we're hearing from record keepers is that in the first half of the year, they'll be communicating with you and have those amendments put in place throughout the year of 2021, so that by the end of 2021, for the Secure Act changes, your amendment should be in place and your plan documents be reflective of those that are, those that are in your plan. Real quickly with the last few minutes, I know we've talked with many of you on in the summer, the Department of Labor finally approved electronic disclosure delivery as your default. This means that you can default for your participants. You can make the default that you just send electronically out your disclosures to those. The big driver of this was behind that, mailing out hard copies is expensive and it runs up costs to the plan. So the Department of Labor approved this summer the ability for plans to just go ahead and deliver those disclosures electronically, and you can make that your default, meaning you can choose that, and then you have to give participants the ability to opt out. Real quickly there, under the methods, they've given you two methods. One is to basically take the disclosures, place them on an internet or intranet and make them available, and then basically you've got to notify, whether by email or other means, you've got to notify all of your participants, terminated and active and such. You got to notify them where they can go to get that disclosure. Method number two is simply if they have an email address that you've got, whether it's work related or a personal one that they've provided, you can simply email out those disclosures to them. Couple of caveats with it is, one, you can make this your default. So moving forward, again, you can give the directive to your record keeper that you want electronic delivery to be the default for your plan going forward. When you do that, you do have to provide an opt-out option. So if a participant does want to opt out and they want to get a paper copy, that you will provide it. The last thing there is you can't bill that particular participant for those. So if they say, hey, I want a hard copy, and you tell them, well, it's a $5 charge to mail it to you, you can't hit them with that fee to do so. So again, I think most of you record keepers have or us have kind of reached out here in the last couple of months on that. I think we haven't really seen most plans that are widely adopting the electronic disclosure. Certainly from an administrative standpoint, it's efficient and less costly. And as I mentioned here, in just the last few days, the Department of Labor just released their final ruling on what are called ESG investments in retirement plans governed by ERISA. And so for those of you that you've maybe heard of this a little bit, ESG stands for environmental, social, and governance type of investments. And these have been investments that have been around for a long time, quite candidly. But you've seen, more demand for these type of investments. And obviously they're a little bit different than your traditional standard or your traditional investments. And so the Department of Labor has taken some time to kind of evaluate these investments to consider whether or not they're prudent to be used in a plan as they go through it. So again, this just came out within the last few days. This one's going to be the final ruling. It's going to be one of the more technical rulings. And so in the next month or two, we'll be communicating with you on what this means. We've been looking at these type of investments for a while now. We've had good experience with them. We have some of you that use them. And so we'll be kind of coming and explaining further, but just real quickly, the ruling gives the new prudence requirement on how you compare these investments. It helps you take into account what's called pecuniary factors only. And I'm not going to get in that today because it's a little bit technical, but we'll explain that and help you kind of go up to speed. There's a tiebreaker exception that involves the pecuniary factors, and then rules for investment alternatives in participant directed DC plans, and then special rule for QDIAs. Essentially, you can't make some of these investments a QDIA at this time. They don't qualify as a qualified default alternative that could be used as a safe harbor under plan. So again, just brand new ruling that has just come out, and one that we'll have more information on for you in the coming weeks. But much has happened in that. So if you have questions, I know we're out of time, and I want to make sure I turn the time over to Kim as he begins, and he's got a lot to share with us. But if you have questions, again, please submit them through that Q&A, and we'll gather them and we'll circle back with you and do our very best to help you answer any questions you may have about what needs to happen between now and the end of the year regarding these the new regulatory changes that have come, and making sure that your plan and your plan documents are ready to take to go into effect and be ready for those things beginning in 2021. So again, just please feel free to submit your questions. We will we'll make a commitment to make sure we get back to you and try and help and answer those. With that, I want to move to our next section and turn it over to Kim Anderson, who's our president and CEO, and who we affectionately refer to as the godfather of 401k at Soltis. You gotta smile, Kim, because you know that's the real title for you.
Well, thank you, Tyler. It's good to be here with you today, and hopefully you can hear me. It's an amazing and unique time, no question. We're grateful that we've learned technology enough to have a virtual meeting here today, and hope that all of you are able to hear and see everything that we're presenting. Today, I'm going to be talking about investments. Our fiduciary, I want to answer 4 questions in my presentation time. 1, what is our fiduciary responsibility to the investment menus that we have for our participants? That's both for the plan sponsor and named fiduciary, and for Soltis, who also is a fiduciary to your retirement plan. Number 2, the question, what are some protections? Some of the safe harbors that are in place to protect the fiduciaries of the plan against the participants' selection of those investment options. Number 3, how many funds should I have in my lineup? I think that's the most popular question we get. Should I have less funds, more funds? What is my responsibility as it pertains to ERISA in coming up with the amount of funds that should be in the lineup? We'll address that. And then most importantly, what are the trends today with plans that have menus and options, and what are some of the increasing trends? So I'm going to just jump in here and begin. First of all, what is our fiduciary responsibility? ERISA does require, under ERISA 404A and 405A, for us to select investment options in a prudent manner. And so the prudent expert rule, which I'll cover in just a minute, is important as we select investment options for the plan. Plan options must be diversified unless circumstances direct that it's not prudent to do so. And so as we look at the number of options that should be in your menu, we want to make sure we have broad, essential building blocks that would allow participants to be able to put a portfolio together that's diversified. And then ERISA 405A, the performance of the investments must be regularly monitored and on a regular basis. Now, ERISA 404C5 deals with your plan default option. ERISA does require, as of 2006, when they came out with the Pension Protection Act, they required you to have a default option for those that don't select an investment. We call that a QDIA, a qualified default investment alternative. And that option can no longer be a stable value or money market fund. It must be a diversified portfolio. So just a couple standards by ERISA. The prudent man rule, we call it the prudent expert rule. As a named fiduciary to your plan, you are required to be an expert at the investment lineup and the investment menu. If you are not an expert and do not have that expertise, you have the opportunity to delegate that to a qualified service provider or an ERISA fiduciary, of which Soltis is, taking on ERISA 321 or 338 fiduciary status. We also have a responsibility and a standard to diversify, as I mentioned before. The diversification standard is that investment plan assets minimize risk of large losses, and that we are allowing for participants to have enough investment options to diversify against those losses, to put a portfolio together that provides that diversification. So protections, what protections do we have in place as we look at investment options? We all often, say ERISA 404C. That is the code in ERISA that provides a safe harbor to you, the named fiduciary, for the decisions of the participants as they select the investments within your lineup. Now, back in 1974, ERISA was written, and it included 3 investment alternatives: cash, bonds, and stocks. In today's environment, the criteria is to make sure that each of those investment options have a materially different characteristic as it pertains to risk and return. And so obviously 3 investment options have been expanded, and we'll talk about the number of options in just a minute. The second part of that safe harbor is that the participant has control, that they have full control of their investment options to be able to make changes in a reasonable manner, at least quarterly, but most of your plans daily, to be able to make any necessary changes to react to risk. And the third thing is disclosure. And many plans were out of compliance of 404C several years ago, but have become more in compliance because of the disclosure laws that have been put in place by the Department of Labor. We have the responsibility to disclose details concerning the investment options. Those can be found on the website through prospectus and fact sheets, but we also have an annual notice called the ERISA 404A5 notice that is sent out annually that has necessary disclosures to the participants. So we have a responsibility to be prudent, to make sure there's diversification, to make sure that we're monitoring the investment options regularly. And the safe harbor we have is ERISA 404C, which is part of ERISA. So now let's talk about the investment option menu and talk about the different investment options that are offered within the menu. We break this out between 3 categories. Individually managed investments. This is for the participants that want to manage their own, that feel they have the expertise and the time to be able to pick their own investments. Mutual funds are used, and in our lineups, we have both active and passive investment options available for the participants. There's also brokerage windows and accounts that some accounts have that allow for a broader selection of individual options for participants to select. We have professionally managed investments. These can be lifestyle portfolios or risk-based portfolios. Target date funds are categorized here as a professionally managed investment, where a participant can select one of these and have it professionally managed by professionals that can help with the asset allocation, the manager selection on a participant's account. And then we have personalized managed investments that have come into the industry. Today, we're going to talk about some of those trends. One of being a QDIA for a managed account. Now, a managed account can be a QDIA, but it can also just be put into plans that gives more personalization to asset allocation, to questions and decisions that participants have regarding their full financial situation and picture. We also want to introduce the dynamic QDIA, which is a emerging trend for the default option of your participants. So I want to go through each one of these categories in a little bit more detail, show trends, and show some statistics and talk about process on each one. To answer the question of how many funds should I have in my lineup, we have to look at our standards of diversification and look at the broad spectrum of risk and return to construct the individually managed investments. So as you see these bubble charts that go up the spectrum of return and risk, this is how we define the market to ensure that we have diversification. Obviously, every fund needs a safe harbor, a money market or a stable value fund that protects against loss. You have the fixed income asset class. And we see plans that have 1 to 4 options here, depending on the preference of the committee. You could have just a core bond fund that would include within that bond fund tips and non-traditional type bonds and high yield bonds. But many plans prefer to have tips or have a non-traditional bond fund, and then an index fund of an active and a passive option. So there could be 1 to 4 options here that could be in a menu of funds under fixed income. As we go into stocks, we look at our US market, large caps, mid caps, and small caps. Each one of those usually has a growth manager, a value manager, and then an index, which we call a blend, which can be a blend of growth and value. So up to 3 options can be in each one of these categories, from large cap, mid cap, and to small cap in your investment lineup. Now, also in the equity market, you have international stocks for participants to choose from. And we break international out into the developed markets, the emerging markets, and then indexes, a passive option within the international area. Now, there can be up to 3 to 4 options in this asset class because there may be some specific preference by a committee to even have international funds that have large caps versus small caps that are in a specific territory. But typically, if we cover the developed world, the emerging world, and then we have a passive option there, you'll have 3 to 4 options in the international equity asset class. And then there's this category on the high end of risk and return. Some of the companies that are on the phone today have their own company stock that are part of their investment menu. There are some alternative strategies, the REITs we see most common in this category. Some of you have gold or commodities or have asked about gold and commodities. Those would be sort of specialty and cyclical type of investment options on the return and the risk spectrum. So if you look at, sort of the standard to diversify, and you look at how many options should I really have in my lineup to allow a participant to participate in each of these various markets, you would have 15 to 20 funds in your lineup on the individual side to cover these styles, these asset classes, and categories of risk and return. Well, what is the industry seeing in the individual funds? The average funds in the industry in the far left column is 22 to 23 funds. That's what the industry is showing. On a median basis, it's 21. Now, these statistics that I'm going to show here are going to show these by size of plan. And of course, we can go into specific industry with you as we meet with you individually. But you can see that about 21 funds is the number of funds that are being offered in the industry according to, plan sponsored defined contribution survey. If we look at the types of vehicles that are used in the menu, mutual funds, 93% are using mutual funds. Some have separate accounts. If you have an insurance provider, especially, we see separate accounts that might be involved in 20% of the plans you can see here. One of the emerging trends is this collective investment trust. And you can see that if you're a large plan, that being over $1 billion, 57% of plans have collective investment trusts in their lineup. And you can see that as you have less assets, 10% to 11% have collective investment trusts in place. This is an emerging trend, especially for those larger plans. But as you know, Soltis has done a lot of work and spent a lot of time in aggregating our assets to bring to you a collective investment trust on your target dates, as well as some of your individual funds. And this is an increasing trend that I'll speak to a little bit later. You can see the percent of plans that have self-directed brokerage windows and accounts, and of course, the other categories that are listed here in terms of employer stock, etc. Which of the asset classes or options are available to participants? You can see here that when you look at the specialty area, REITs, 26% have a REIT option in their lineups. A small percentage of sector funds, gold and precious metals or commodities, 6.5% of plans out there offer that type of an option. And then Tyler mentioned we just recently received some direction on these ECG funds, or these environmental, social, and governance funds. About 10% of plans offer some kind of an individual option in that category. Well, from a process standpoint, you know that we use a quantitative and qualitative process for evaluating these options. Soltis has been hired to take on full responsibility or co-responsibility on the process that is implemented for reviewing these individual funds on a quantitative basis, looking at performance history and peer ranking. On a qualitative side, going really deep on the parent, the company, the process, the people that are involved, the managers, et cetera. We go on site, and our investment division does a good job of making sure that we are monitoring the investment options that have been selected for your plan. We have reports, our consistency report. In our consistency report that's provided quarterly, we have the quantitative and qualitative status in green there, and the check marks if they pass. And of course, if a fund goes on watch, that requires us to do further due diligence on the funds that are in your lineup. We have the quantitative scorecard that gives you just the raw numbers, 1, 3, 5, 10-year returns compared to indexes and benchmarks. And we have our qualitative scorecard that looks at some of these qualitative issues, risk as it pertains to the return of a manager, the manager tenure, the asset size, etc. Now, your investment policy statement indicates these categories, and our reports report on them quarterly. Well, let's go to professionally managed investments that are in your lineup. There has been an increasing level of customization and innovation in this area. Again, the concept here is that a participant goes into one of these portfolios and they get professional management. It can be balanced funds, risk-based models, target date funds, which are the most popular at this point. And then we're going to introduce the dynamic QDIA with target date funds. And the emerging trend is managed accounts, which is more personalized approach to professionally managing investments. Now, these are the investments that qualify to be a qualified default investment alternative, or a QDIA. and by the DOL. Well, let's look at, in the industry, the plans that have these professionally managed investments available. You can see the target date funds, 80% of plans have target date funds, balanced funds. You can see the percent of plans that have a professionally managed or managed account. And I've highlighted here because this is another emerging trend. If you look at the over $1 billion plans, 51% of them have a managed account solution. And that is going down to some of the smaller plans now as well. And we're excited, to introduce managed accounts to you today. In our investment policy statement, we must choose a QDIA, the Qualified Default Investment Alternative, and that is based on the demographics of your plan and the participants. I'm just going to quickly highlight, because we have T. Rowe Price that is going to go into some depth on the target date funds. The Department of Labor did come out with some criteria that we must use to monitor the target date funds. And we have put those in your investment policy statement to look at performance and asset classes, to look at the glide path and understand what's happening with the glide path, to look at the fees and so forth. Those are in your investment policy statement. And today we have the opportunity to have the manager here to talk to many of these areas of monitoring of the target date funds. In your quarterly packet, we provide you with a report that details all of these areas. So we have the glide path, we have the different statistics of your target date fund, the performance history, we have risk characteristics that are reviewed, the fees, et cetera. And so target date funds are a source of a professionally managed investment. Now, one of the emerging trends is this collective investment trust, or CITs. I want to take just a minute to explain that trend and what it means. A CIT is a pooled investment that is not subject to the 40 Act. It's usually held by a bank or a trustee. They are available for certain retirement plans, definitely 401ks and 457 plans. They're used in endowments and high net worth, type portfolios. 403B plans at this point are excluded, except for churches. Some churches that can offer CITs in their plans currently. CITs, there's about a quarter of the assets that are in ERISA plans that are in CITs today. When you look at the assets, they are moving downstream, as we mentioned and showed in the trend, to mid-sized plans, and they are very popular on the QDIA side of investment menus. Here's just some of the assets: $890 billion in CITs today, $1.3 trillion in regular mutual funds. And you can see in this next slide that there's a trend. As you look at the light blue there, there's a trend going towards CIT assets. CIT assets can only be, effective if you have a large scale of assets that allow you to reduce the expenses. Morningstar's research shows that CITs are usually 91% of the time cheaper and less expensive than mutual funds. And that is surely the case in the plans that we have here with your plans. I wanted to show you, we did implement over the past year, 2 years, CITs and the target date, T. Rowe target date funds, as well as some of your individual funds. But I wanted to just demonstrate that many of you, if not all of you, have the SIA T. Rowe Price target date funds, same management, same glide path. The difference are the fees or the expenses. And you can see from 2025 to 2060, the savings, the cost savings that is incurred by going to a collective investment trust on your target date funds, up to 14 basis points of savings that have been provided to your plan. Now, again, these these CITs could only be put in place because of having over $1 billion of assets in these particular funds. And so we're grateful for the opportunity to bring CITs to your plan, and it is definitely one of the trends. Well, let's talk about the other trend, and that's managed accounts. Again, we showed you in the industry that larger plans are over 50% of them have a managed account solution, and we're starting to see this come down to smaller plans. We want to announce today that we are one of a few advisors that Morningstar has actually contracted with to provide a managed account solution. They are the back office, Morningstar, for many of your big providers that are providing a managed account solution. And Soltis is excited about rolling out the first quarter of 2021, a managed account solution that is aligned with Morningstar's tool. So let me just quickly, in the time remaining, talk about managed accounts. The Morningstar Retirement Manager that we're contracting with gives a digital platform that's designed to reach better outcomes in asset allocation. And so it goes beyond just an age. We're looking at savings rate recommendations that come from this. We're looking at income goals, projected retirement income amounts, a personalized asset allocation strategy that changes when things change for a participant in terms of the information that's provided, and the ongoing monitoring and rebalancing of your account over time. If we were to compare to the target date fund, the target date fund has provided a asset allocation that's professionally managed based on your age. That's the one criteria. When we go to a managed account, we're looking at other things like your outside assets, the household assets, your retirement goals, other items that are important as you start to look at your retirement. Am I saving enough? What is my monthly income that would come from the savings that I have? Will I outlive my money? Can I guarantee a portion of my retirement income, et cetera? So a managed account is personalizing it more than some of the professionally managed accounts have been able to do over time. So I'm just going to show a quick example. In a target date fund, you basically indicate your age, and based on your age, a glide path from an equity allocation to bond will be automatic for all participants. But what we find is for a 55-year-old, that can range from 70+% in equities to even as low as 40 to 30%. And so what a managed account does is get more information from the participant and allow for a more personalized asset allocation to be given to the participant. We see with more information that's provided, there could be an 87% difference in what the equity allocation would be for a 55-year-old. And that's what a managed account allows us to do, is to make sure that that asset allocation is more appropriate to your personal situation. It has been shown that 71% of participants in a managed account end up increasing their savings rate, which is the most impactful way to improve outcomes. And that managed accounts participants increase their savings rate and their average deferral rates when they participate in a managed account. Now, in the last minute that I have, I do want to describe what a dynamic QDIA is, because we want to be able to explore this with you. It's really simple. A dynamic QDIA is a default investment alternative that if you're doing automatic enrollment, participants would go into a QDIA, or if a participant doesn't elect an investment option, they automatically go into the QDIA. We showed you that the majority of assets and plans have a target date fund as the QDIA. Well, how a dynamic QDIA works is it combines the target date funds with a managed account. And what it does is defaults your participants into a target date fund, And most target date glide paths would keep a participant for the first 20 years to 25 years at 90% stocks versus bonds. And so what the dynamic QDIA says is that let's determine a certain age in which a participant needs questions answered, a more dynamic asset allocation based on personal situation, and let's designate that age. And at that age, there's a transition that takes place from a target date to a managed account. And so you may choose the age of 50 or 55, 45, whatever age you feel is most appropriate. And at that time, a participant gets automatically defaulted into the managed account program. And so as I mentioned to you, the Soltis has teamed up with Morningstar, as well as many of the providers out there, to be able to bring to you the managed account option, as well as to evaluate a dynamic QDIA, which combines the target date with the managed account solution. So with that, I just want to summarize in the final of my presentation, we do have an important fiduciary responsibility as it pertains to the investment options that we provide to our participants. You have hired Soltis as a fiduciary to take on that responsibility. You've delegated much of that responsibility to us as an expert. We must make sure that we understand ERISA's standards for diversification and for selection and monitoring. And we must, take advantage of the safe harbor that's available to us, which is ERISA 404C. The number in your investment lineup, as we have that discussion, will be based on having the essential building blocks for your participants to be able to put a good portfolio together that hedges against risks and diversifies against risk. And the emerging trends that we've identified here in the investment world are these ESGs, which the Department of Labor just came out with some criteria there. Collective investment trusts, which we're excited to say we've already implemented in your lineups, that we'll continue to look for those opportunities for collectives to reduce expenses in your individual lineups. Managed accounts, we're excited about the first quarter of this year rolling out our managed account solution, and we're excited about the managed account solutions that are available through your record keeper. And then we are also looking at and seeing this dynamic QDIA being implemented to further help a participant in their asset allocation decisions. So thank you very much for the opportunity to remind you all of our responsibility, the protections, and the trends on the investment side. Tyler, with that, I'll turn it back over to you.
Thank you, Kim. Thank you for the detail. And as Kim said, these type of assets are the largest in most of the plans, and therefore the level of fiduciary diligence that needs to be done is certainly there. And we're excited to kind of move into that. We've got Bill Wallace and Andrew Kuhn with T. Rowe Price that we'll be moving on to. And I just a quick reminder for those, if I know we're pushing on time, but please feel free, if you have some questions, please feel free to submit them. Again, if we have time, we'll answer them. If we don't, we'll make the commitment to circle back and make sure that we get them answered for you. So I'm going to turn the time over to Bill Wallace to take a few minutes and then introduce Andrew.
Thank you, Tyler, and good morning to everybody. Our focus now is we're going to take a deeper dive on the target date fund space. Taken a list of responsibilities for investment committees as you evaluate and put target date funds into your lineup. Just a few of the things that the Department of Labor expects is, one is establishing a process for comparing and selecting target date funds, establishing a process for the periodic review of selected target date funds, understand the fund's investments, allocation, asset classes used, and glide path, review the fund's fees and investment expenses, develop effective employee communications, and overall, document the process. One thing that, for those of you, of course, working with Soltis, know that we help drive these things for you, for your committee, to ensure that you're following these processes, and that's a large part of the value add that we bring in the target date process. So with that, I just wanted to take that a little bit deeper dive into what the Department of Labor is expecting. We're fortunate today to be able to have Andrew Kuhn from T. Rowe Price Associates to talk to us today about T. Rowe Price target date funds, which many of our plans use. Andrew Kuhn is a vice president with T. Rowe Price. He works in the multi-asset division. He's a member of the Target Date Solutions investment team. Andrew's investment experience began in 2008, and he's been with T. Rowe Price since 2013. He started there in the individual investor and client development department. Prior to joining T. Rowe Price, Andrew was employed by RBC Wealth Management, where he worked with high net worth families and institutional clients. Andrew earned a bachelor's degree in economics from Loyola University. And with that, Andrew, we'll turn the time over to you.
Perfect. Thanks, Bill. And first, certainly want to thank you and everyone at Soltis for giving me the opportunity to talk to all of your clients about the T. Rowe Price retirement funds, because we are really excited about some recent enhancements that we made to our target date fund lineup, and certainly really excited to talk to all of you about how we went through the process of making this decision and coming to the conclusion of making these enhancements, and then how you as plan sponsors can take some of that information back and be able to make a more informed decision about your target date fund offering for your employees. So I'll start on page 3. And before kind of diving into the actual enhancements, I did want to take a step back and make sure that everyone's kind of aware of what is the goal of the retirement funds. What are we doing here? What is the investment objective that we're solving for? And the retirement solution is really designed to help individual investors generate a sufficient nest egg and a sufficient balance at retirement to enable them the ability to withdraw money throughout their entire retirement. And it's really not just about helping individuals meet their monthly income needs, right? That's obviously the first objective that we're trying to solve for, but it's also ensuring that even in retirement, they have a sufficient buffer so that if they do experience some sort of unexpected expense. Generally for retirees, when we poll them, we hear about healthcare, unexpected healthcare costs creeping in. We don't want an unexpected healthcare cost to completely derail someone's retirement. So our goal is to be able to build up a sufficient enough buffer in an individual's account so that if they do experience some sort of unexpected cost, that it won't completely derail their retirement. And just a level set, I know I heard Kim talk about, glide paths a little bit earlier, but just a level set for everyone to make sure we're on the same page. On page 4, because I'm going to be talking a decent amount about the glide path, I thought it made sense to kind of just visually show everyone what our glide path looks like and what the enhanced glide path looks like. And really, a glide path is just the visual representation of the percent of stocks and bonds that an individual will own at any given point in their career. So you can see on there on the far, as an example, on the far left-hand side of the page, for your youngest employees, those that have 30 plus years until retirement, our glide path will start off at 98% equity. And really the name of the game there is to grow the assets as much as possible because they still have 3 decades until they likely will need to withdraw any of the money from their account. And then you see as you move from left to right, we start to de-risk the portfolios automatically for your employees and start shifting money out of stocks and into bonds as the goal starts to shift from growth being the dominant factor that we're trying to solve for, to balancing market risk and growth. And as I kind of already alluded to, we recently announced some enhancements to our glide path, and really going to spend the bulk of the time kind of going over some of the research and findings that led us to making these enhancements. And I think some specific to plan sponsors and some specific to participant behaviors that I think you all will likely find interesting and can take back with you. So on page 5, these are really the 4 key factors that led us to making the enhancements to the glide path. And I'm going to go into each of these in a little bit more in depth on future pages, but just to kind of lay out what those 4 different factors are. You can see there in the top left, plan sponsor preferences. We wanted to ask the question of plan sponsors, why are you offering a target date fund to your employees, right? What is the goal of you offering a target date fund for your employees? And wanted to see kind of the response that we got to make sure that our investment objectives that we are trying to solve for are aligned with why plan sponsors are even offering a target date fund in the first place. Because if there's a disconnect between why a plan sponsor is offering a target date fund and the investment objective that we're trying to solve for, we're not really meeting the needs of our clients and of plan sponsors. The second in the top right is participant headwinds. We asked the question, how well prepared are individuals in saving for retirement? Are they very well prepared? Are they saving early? Are they saving enough? Or are there some headwinds, as you can kind of maybe allude from the graphic there, that there are a lot of headwinds that individuals are facing in setting themselves up to have a successful retirement. The third in the bottom right, participant behavior. We really asked the question, how do individual investors respond to market stress? Do they run for the hills? Do they sell everything in their account and go to cash at the first sign of volatility? Or do they kind of more ride it out and stay the course and stay invested? And we wanted to look to see how are individual participants actually behaving during periods of volatility. And then fourth is modeling advancement. So this is more, internally at T. Rowe Price, and we're continually trying to advance our capabilities and are always trying to strive to model the problem as realistic as possible. So again, it's these 4 factors really coming together that led us to have a high conviction to make the enhancements to our glide path. So page 6, starting with the plan sponsor preferences. So we went out and asked plan sponsors, why are you offering kind of a target date fund? When you're offering a target date fund or other QDIA. So I'm on page 6. Not sure if maybe my video is delayed there. But so we asked plan sponsors, there we go. So we asked plan sponsors, when you're offering a target date fund or other QDIA, what is the most influential? Like, why are you offering that? And you can see there almost 60% said that they're trying to offer a QDIA, mainly a target date fund, so that they can help their employees achieve the highest retirement income opportunity possible. And then a follow-up question is, as a plan fiduciary, we wanted them to rank the different risks that they're most concerned about for their participants. And you can see there that the number 1 risk, almost by the 2-to-1 margin, is longevity risk. And longevity risk is just the risk that an individual will outlive their money. And I'm going to talk to you a little bit more about that on subsequent pages. And the third question that we asked is, given that longevity risk is going to be probably the highest risk that you're most concerned with, how would you as a plan sponsor want to mitigate longevity risk? And you can see almost 2/3 of individuals said that growth over a target date investment would be the main way that they would want to solve for that longevity risk. So the big theme and the key takeaway for us as investment managers that we heard loud and clear from plan sponsors when we asked was that they're offering a target date fund to help individuals, their employees, be able to sustain income throughout their entire retirement. They're most concerned about their employees outliving their money, aka longevity risk. And the way that they would want that to be solved is to try to grow the account as much as possible. So that from a plan sponsor perspective, we heard that trend loud and clear, that income throughout retirement and the risk of outliving money was a key risk that many of our plan sponsor clients were certainly concerned about. And then on the next page, page 7, when we look at participant headwinds, there's really 2 massive headwinds that individuals face in setting themselves up for a successful retirement. The first being savings rates. So there on the left-hand side, we have a record-keeping database here at T. Rowe Price. So we record keep for almost 2 million participants and thousands of plans. So we really have access to real-time data to be able to see how are individuals behaving, how much are they saving, how much is coming from employers and how much isn't coming from employees. And all of that really feeds into our decision-making process of how we structure our target date funds. And what you'll see here on the page is that across almost every age cohort, individuals are not saving enough to set themselves up, right? The industry benchmark is around 15%. And this is typical for almost all of the plans that we look at. For the youngest individuals, they're not saving, nearly enough. On average, 20-year-olds are saving around 10%, 30-year-olds a little bit better, around 11 or 12. And then really it's only when you get into your 60s, when retirement really starts to become front and center of many individuals' minds, that you see people start to save more and ramp up their savings. But the reality is if an individual needs to be saving around 15%, they need to be saving a heck of a lot more in their 50s and 60s if they were under saving earlier in their career. So on average, we're just seeing most individuals not saving enough for retirement. And then the problem's only getting harder for those individuals. So I think plan sponsors are correct to be worried about longevity risk for their employees, because it's a risk that we see from a data perspective as well. And that's the chart there on the right-hand side of the screen. And what we're looking at here is the conditional life expectancy. So basically, what is the life expectancy of an individual that reaches the age of 65? What is their life expectancy going forward? And you can see just in the last 2 decades that has increased by over 2 years. And that trend, when you look back to the 60s, 70s, 80s, 90s, that's an upward sloping line, meaning that life expectancy is continuing to rise. And with increasing in technology within the medical sector and other areas, we really think that is a trend that's going to continue. So really participants are getting hit from both ends. They're not saving enough to set themselves up, and the problem's only getting harder for them to solve, because the likelihood that they're going to need this money to last multiple decades, 2, sometimes 3 decades, is only increasing, right? So they really participants are really having a tough time setting themselves up to have a successful retirement. So the third pillar that I mentioned earlier was participant behavior, and that's going to be on page 8. And what we looked at in our own record-keeping database, and I would say that these trends that I'm going to talk to you about really carry forward across the entire industry. So it's not just a T. Rowe Price phenomenon. You're going to see this across most target date fund providers. And that's the fact that target date fund investors don't trade much, right? I think that there's really a narrative in the media that when volatility hits, individuals freak out, they run for the hills, they sell all of their stocks, and they go to cash or a money market vehicle. And we certainly do see a slight uptick in the amount of exchanges, or the percentage of individuals that are moving money out of a target date fund, either to a different vintage, into stocks, into bonds, or into cash. So we just look at, did a target date fund investor make an allocation change? And what you'll see there in the dark blue line at the bottom of the page is that target date fund investors really just don't trade. And we just had one of the most volatile periods that we've experienced in the last 2 or 3 decades happen in the first quarter. So we have very recent data to show that the vast majority of target date fund investors sit on their hands, they stay invested, they stay the course. Over 98.5% of our target date fund investors did not make an allocation change during the most recent period of volatility. And that really gives us as investment managers of target date funds a lot of comfort, because all of the data that we see tells us that time in the market, that the compounding over many years is what will lead to a successful retirement. It's not trading in and out of the market and trying to time it perfect. It's investing early, it's investing enough, and it's staying invested, right? Those are the key pillars that I think everyone, intuitively knows, but we are humans, right? So we do have emotional aspect, and none of this is to downplay kind of the emotional stress that volatility can play on an individual's kind of mindset of making sure that they have enough money in retirement. But what you'll see is that for those individuals, especially in this most recent period of volatility, those that stayed invested really reap the benefits, because equity markets have come full circle and are reaching new highs, as we speak. So those that stayed invested certainly reap the benefits of that market recovery, and staying the course will certainly set them up to have a better chance at having a successful retirement. Page 9, this is looking at kind of the modeling advancements that we make. So when we think and look back, we launched our retirement funds back in 2002. And when we look at kind of how we were modeling the problem back then, what was very advanced at the time is now just very basic and table stakes. And one of the key themes that we're always trying to do with our research and development team, which is nearly 30 individuals that are focused on making sure that we are modeling the problem as realistic as possible. And I'll give you kind of an example of what we're trying to do within our modeling. So there's some target date fund providers and others in the industry that will just use simple averages for demographics. They're looking at, how much individuals are saving and just taking kind of a simple average and inputting that into their model, and then it'll kind of spit out an asset allocation. Well, what we try and do is we take all of the data that we can and we build kind of a distribution curve, a normal bell curve, if you will, taking you back to your statistics days. And what we're trying to do is we recognize that plans are very heterogeneous, meaning that there's not just a simple average that you're trying to solve for, right? You're trying to solve for a low saver, low earner, as much as you're trying to solve the problem for a high saver and high earner. And what we do by developing that curve is we're able to see how our glide path can impact different cohorts and different individuals within a population, because if you're just trying to solve for the simple average, you may be forgetting about a lot of those individuals that maybe aren't saving enough or aren't earning enough, and that you may be making a decision that would be at their detriment. So by us taking kind of that full distribution, we're trying to take the a very holistic approach to looking at how our glide path can improve outcomes for all individuals, not just for kind of the simple average. On the next page, page 10, this might be one of my favorite charts to look at, because what this chart is looking at is the different bull and bear markets that the S&P 500 has experienced over the last 7 decades, so going back into the 50s. And what first jumps out at the page, should jump out, is that bull markets are longer and more pronounced than bear markets. And again, this is not to say that, again, that from an emotional standpoint, that bear markets, don't feel good, right? Because they don't. For me as an investment professional, going through this most recent period of volatility, going through the 2008 global financial crisis, it did not feel good to see my account go down and to know that our clients' accounts were going down. But I really take comfort in knowing that our design is structured such that we're trying to provide the best long-term outcome for clients. And what we know is that bear markets are both preceded and followed by bull markets. So you can see that on this chart, that while bear markets can be pretty steep and come out of nowhere, bull markets are much more pronounced and much longer. And that's really what we're trying to capture to help individuals set themselves up for a successful retirement. We're trying to capture all of those bull markets to be able to grow assets for individuals to help set themselves up to have a fighting chance at having a successful retirement. Looking at some data on page 11 in terms of historically how our glide path would have performed to a different glide path. So this is comparing our glide path relative to the S&P target date glide path. And the S&P target date glide path is just kind of, it takes all of the target date fund providers that are out there and takes the average of their glide path. So it's kind of, it's a good benchmark to look at how are all the other target date fund providers structuring their portfolios and how is it different from ours. And one of the key differences that we see relative to many of our peers is that we have a focus on growth. And because we have a focus on growth and because we have a focus on mitigating longevity risk, we believe that equity is your best friend to be able to mitigate that risk over long periods of time. Therefore, we tend to have a higher equity glide path. We have more equity at most points of the glide path relative to many of our peers. And what this is looking at is how successful would that have been during different market environments. So we take this all the way back to the Great Depression, and we're looking at rolling time periods. So we're looking at very long time periods, 40 years and 30-year time periods, rolling from the Great Depression up until the most recent quarter end. And what you see there is that 100% of rolling 40-year and 30-year periods, an individual that would have been invested across our glide path would have had a higher account balance at their retirement date relative to someone that would have been invested in the S&P target date glide path. And just as an example, over the 40-year period, an individual would have had over $200,000 more in their account based on our assumptions that we put into the model in their account relative to someone in the S&P target date glide path. And what you'll also see, though, extremely strong hit rates over what we would consider shorter time periods, 20-year and 10-year. And I know that may sound odd, that 10-year and 20-year, we would consider kind of shorter time periods. But the way we think about the problem and the retirement problem that we're trying to solve for is that this is a 70-year problem for many individuals, especially your younger employees that are coming on board now, because they're likely going to be, starting to save in their early to mid 20s. They save for about 40 years. They're retiring in their mid to late 60s, and then the likelihood that they're going to need this money to last 20 or 30 years is only increasing, right? So that's how we get to trying to solve for that 70-year problem. But even over those shorter time periods, 10-year and 20-year, you'll see 94% of the time over rolling 20-year and over 80% of rolling 10-year periods, our glide path would have resulted in a higher account balance for an individual at retirement. And it's not just the strong hit rates. What you'll also see there is asymmetric returns. And that's just kind of a way of saying that the downside is limited and the upside is much greater. And we show that in the bar charts. So the dark blue bars are showing the average outperformance of our glide path relative to the lower equity S&P target date glide path. And in the 20-year and 10-year, those little gray bars kind of to the right of the dark blue bars, that shows the average underperformance of our glide path. So in the rare cases where our glide path would have resulted in a lower account balance, you can see that an investor really wasn't giving up that much to be in our glide path relative to the S&P target date glide path. But for those individuals that would have been invested over 20 and 30, 40-year time periods, you can see that the upside is much greater than the potential downside that you see over those shorter time periods. And from an investment management perspective, seeing that asymmetric kind of return is what we are trying to do day in and day out. When we can kind of minimize downside risk and not cap or have a greater ability to outperform, and have a wider margin there, we will take that all day, every day, because that's what we're trying to do is mitigate risk as much as possible while trying to not mitigate kind of the growth potential that an individual could see. To put some other numbers behind it on page 12, and this is getting back to what I was talking about earlier, in that we're trying to solve for all individuals, right? There's a lot of numbers on this page, a lot of bars, so I'll kind of level set for everyone what we're looking at here. So what we did is we took data and looked at how our glide path would have performed relative to the S&P target date glide path for different savings and earnings profiles. And again, this goes back to my earlier statement about when we're modeling the problem, we're trying to model it for everyone. We're not just trying to model it for kind of one cohort, if you will. And what you'll see there is that across the board, our glide path, and it represented in the dark blue bars, would have increased consumption. An individual would have been able to consume more in retirement had they been invested in our glide path relative to the S&P target date glide path. And just as a case study, in the interest of time, rather than going through each of these, if we look at that middle saver, middle earner, if we assume that this individual will need about $60,000 per year in retirement, our glide path would have increased consumption by around 7.7% on average. A 7.7% increase kind of on the surface may not seem like a big difference, right? 90 versus 84%, is that really worth it? Well, when you put kind of real numbers behind it, an individual taking out $60,000 a year, a 7.7% increase to their consumption now means that they can withdraw an additional $4,600 per year in retirement and for their entire retirement, right? That this consumption is modeled throughout their entire retirement. We think that someone withdrawing $60,000 a year, if they can withdraw an extra $4,600 a year, that's a meaningful increase to their standard of living and increasing the probability that if they don't need that extra $4,600, that the probability that they're going to outlive their money declines, right? We're mitigating longevity risk. And really we're doing that by compounding the higher equity profile relative to many of our peers over many years and many decades. And all of our research tells us that that is the best way to help mitigate longevity risk. And again, to kind of tie that back to what individuals are telling us from a plan sponsor perspective. So plan sponsors are telling us that they're offering a target date fund to help with their employees, to help set them up with an income stream. They're very worried about longevity risk for their employees. And the way that they would want to mitigate longevity risk is through growth. So the way that we're mitigating longevity risk is through having a higher equity profile than many of our peers, which will lead to higher growth. So we think that our investment objective that we're trying to solve for with the retirement funds and setting individuals up to have a successful retirement, to enable them to withdraw money throughout retirement and to try to grow that balance as much as possible, is really aligned with many of the plan sponsors that are offering a target date fund and why they're offering a target date fund for their employees. So going back to making sure that investment objectives are aligned, we really believe, after hearing feedback from plan sponsors out there, that the investment objective that we're trying to solve for is the investment objective that they as plan sponsors are trying to solve for by offering a target date fund. So that's a little bit, on the enhancements and a lot of the rationale behind, why we decided to increase the level of equity for our glide path and continue to focus on growth for our individuals. I wanted to take maybe 5 minutes or so. I know you have an economist coming up next that's going to be talking about the markets. But I did just want to spend a few minutes talking about our outlook and talking about how we're positioning our portfolios, given that there's really a lot going on in the markets today. So on page 14, when we go out and look at the world, we find a lot of positives and a lot of negatives. And I know that I did study economics in college, although I am not an economist now, so I will be a two-handed economist. And on the one hand, you have a lot of unknowns out there right now. The number one being the virus, right? I thought I was going to be able to take elevated political tension off of this chart, but given that it looks like President-elect Biden will ultimately be the winner. There still are a number of lawsuits and still kind of political tension in Washington. So we're kind of still leaving that up there as a potential unknown. But pairing that kind of political tension, it's not just about, who's going to be the next president of the United States, but it's also thinking about fiscal stimulus. Because while that certainly has been one of the positives that we've seen, that fiscal stimulus and monetary stimulus, we've just seen tens of trillions of dollars, both here in the US and across the globe, get pumped into the system. I think the next question is really, if we see a resurgence in the virus and in cases which the data is already kind of pointing to that the fall and winter, could be really tough for us here in the US and in Europe. If you start to see states and municipalities start to restrict access, to start to shut down their economies, maybe not as much as we saw in March, and we likely won't see those strict of lockdowns. But if we start to see that, you likely are going to need to see some fiscal stimulus, because the goal of fiscal stimulus from day one was a solvency bridge. It was to get us to the other side of this virus. And I think that the fiscal stimulus that the government's enacted earlier this year really set us up to be able to do that. While we did, and I'll show you on subsequent pages, while we did see an increase in bankruptcies and kind of stress in the markets, it could have been a lot worse, and we likely would not have seen the type of recovery that we've seen thus far if we did not have the government kind of step in and help get us to the other side. So that's kind of on the negative side. On the positive side, the progress towards a vaccine. The virus is going to be the biggest headwind for us, but we got some good news out of Pfizer here earlier this week about their phase 3 trials and a vaccine. And I think our base case was always that we were going to have some sort of vaccine. 90% efficacy, I think, if you listen to any of the epidemiologists and any of the other individuals that are more attuned to kind of vaccine development, 90% blew away any of their expectations. It is just kind of the beginning of the phase 3 trial. data coming out. There is more data to come out, and we certainly will look to see if that trend continues. And if it does, that is a really positive for us. But there still are many other vaccines in the pipeline. And I think because of the number of vaccines and the number of countries and the number of companies that were looking to develop a vaccine, we were fairly positive on the fact that we were going to see a vaccine at some point, either in late 2020 or early 2021, and that over the next 12 to 18 months, we are going to be able to get back to a more quote unquote normal environment. But that does not mean that there will not be volatility over the coming months. So page 15, just kind of to give a backdrop of what the economic outlook was and what it is now. What you're looking at the top chart is you're looking at sentiment indicators, economics, so hard data indicators, and then financial conditions indicators. And what you'll see across the board is that whether you're looking at sentiment, hard economic data, or financial conditions, we fell off a cliff earlier this year. And not surprisingly, hard economic data, it tends to lag many of the other economic indicators and sentiment and financial conditions, but they all fell off a cliff. What you'll see there is that many of the conditions have improved. And improved pretty substantially since we bottomed out in March. As I mentioned, weekly economic indicators tend to be a lagging indicator. So that is why you're likely seeing that not pick up as much as the sentiment and financial conditions. But I think the broad takeaway is that things have been getting better. Again, as I mentioned earlier, we think a lot of that had to do with the fiscal stimulus and the monetary stimulus that the Federal Reserve pumped into the system to be able to help stem the tide, because as we all know and went through earlier this year, things got ugly, and they got ugly quick. And the government really stepped in very quickly. I'll give them credit, and we're able to kind of stem the tide, and then you see kind of things start to get better pretty quickly. To put things into perspective, some people are asking, well, we went through a recession. They hear these GDP numbers, the biggest drop since the Great Depression, and the fastest drop. But when we look at kind of bankruptcies, companies going out of business there in the bottom left, what you'll see there, to put it into context, during the global financial crisis, you see that's that big spike there towards the middle. And this data is as of almost the end of September 25th of this year. And what you'll see there is that, we did have a spike higher, but we really have not seen the level of bankruptcies, corporate bankruptcies, that we saw during the global financial crisis. And again, a lot of that has to do with the liquidity that the Fed and Congress pumped into the system earlier this year. Individuals are actually doing extremely well as a whole. And what we looked at is consumer credit card indicators. So we looked at how much individuals are paying off credit cards, and then delinquency rates. And what you'll see is that delinquency rates, maybe counterintuitively, fell during the first and second quarter of this year, and individuals started paying off more of their credit card debt. And a lot of that had to do with PPP loans and the additional unemployment insurance that many individuals got earlier this year. Many individuals were actually making slightly more on the unemployment with the additional $600 than they would have in their typical jobs. And rather than go out there and spend a lot of that money, some of that money absolutely got spent. But we did see a lot of individuals try to shore up their own personal balance sheet, which we think is a really good thing, because if we do see more economic stress over the coming months, individuals and corporations are, we think, on a much more solid footing than they were earlier this year. Not to say that they were not on a solid footing to begin the year, but they certainly, we think, are on a more solid footing to be able to weather any volatility that we may see coming up. So page 16, really one of the key themes that we've seen and that you've likely heard is that a lot of the stocks that have done well so far this year are the stocks that are taking, that were part of the trend of the work from home environment. So whether that be Peloton, Zoom, Netflix, and the like, a lot of those companies are what we call growth stocks. So a lot of growth stocks tend to be technology stocks. They tend to grow more than value stocks. So value stocks you can think of as financials companies, energy companies. And it's not to say that those aren't good companies. There's a lot of really good companies in there that are making good money, but they're just not growing as much. But one of the big shifts that we saw this year is the dominance of growth companies. And whether you're looking at it on these different ratios, and I'm not going to go into what all of these ratios are, but really the big takeaway is that growth stocks and technology stocks have really shot the moon here. And most of the returns that we saw up until about, August, September, were really driven by these technology stocks and growth stocks. So from a positioning standpoint, and I'm going to finish up here on page 17 on the last page. From a positioning standpoint, what you'll see here on page 17 is that we're neutral stocks and bonds. So we really think that now's not the time to be a hero, and I'm taking that from Sebastian Page, who's the head of our multi-asset division, and that's what he's been telling all of our clients. Now's not the time to be a hero. On the one hand, you have the virus, you have all of these unknowns, you have domestic and international unrest, and on the other hand, you had trillions of dollars of stimulus getting pumped into the system. You have the likelihood of one, if not multiple candidates for a vaccine coming to fruition soon. But there likely will be some volatility because, as I mentioned earlier, the virus is really the name of the game. And we think the next 6 months, you're likely going to see more volatility. But that said, we are fairly positive on the economic outlook 12 to 18 months down the road. So with that, that's kind of how we're broadly positioned in our outlook on the economy. Maybe Bill, I'll pause here and turn it back over to you.
Thank you, Andrew. Appreciate that. Very interesting and helpful understanding the changes in the glide path and so forth. Tyler, are there any questions that we want to take now, or do you want to just move on?
Well, we've got a few that, in terms of maybe for Andrew and the team, I think, and Andrew, thank you. Appreciate kind of the in-depth and know that you're digging in there. We've talked with a lot of our plan sponsors about longevity risk and about the research that you guys have done there. Can you maybe talk a little bit about, in this space, you see a big difference in glide path, and a lot of that, some of that's being driven by, products that want to be more middle of the road. Can you maybe just speak to, why T. Rowe, you guys have taken the approach of really looking more, I think, at the participant than kind of the product or the category, and just talk through how that's kind of figured into the glide path? I know you've covered that a little bit, but maybe talk a little bit deeper into that.
Yeah, it's a great question because, when we launched our glide path back in 2002, and I think it's important to note for everyone here on the call that while we're making enhancements to our glide path, our guiding principle and our North Star has never changed. Our core investment objective that we've always been trying to solve for from 2002 and to this day is to help individuals be able to sustain income throughout their entire retirement. Mitigating longevity risk is another way to say that. That's always been the risk that we've been trying to mitigate. And when we look back to 2002, when we launched the retirement funds, we were one of the first. We were not the first, but one of the first. And we absolutely had a higher equity allocation than almost all of the peers that were out there. And we were kind of an outlier, if you will. And we've always taken the approach of, we want to hear what plan sponsors' investment objectives are. We want to look at hard data. We want to look at how participants are behaving. We want to look at how long are they staying in plan. How are they using this money after retirement, if they do decide to leave the plan? Are they cashing out, or are they rolling over to an IRA? We take all of that into consideration. We take all of that hard data into consideration to see, how can we, as an investment advisor, take the things that we see happening, how can we take that into consideration when we're building our glide path? I think it's important to note that, we don't have control over how much individuals are saving. We don't have control over how long they're going to live. We don't have control over why plan sponsors are offering a target date fund, but what we do have control over is taking all of that data, being very curious, going out to the marketplace, figuring out all of these things, and then taking that back internally and then doing something that we do have control over. And that's the asset allocation, that's developing a product and a solution that ultimately will meet the needs and objectives of our clients and of our plan sponsors. And I think Jerome, one of our portfolio managers, says it best: target date fund development is as much art as it is science, right? We don't just take data. right, from all these various sources. We absolutely do. But we go out there and we talk to plan sponsors. We go out there and we poll individuals. We go out there and have these conversations constantly and get feedback from the marketplace. Because if we're developing a solution that just from a quantitative standpoint, we believe is the best, but it doesn't actually meet the needs and objectives of the plan sponsor community, of individual clients, well, we've missed the mark, right? So we have not done our due diligence and aren't doing a service for those individuals and helping them to set themselves up for a successful retirement. So I think it really, an important takeaway is that we really do take a lot of hard data, but we go out and talk to individuals in the marketplace. And certainly we do look to see what others in the industry are doing, but we're really not concerned with that as much as, what are individual participants doing? What are plan sponsors doing? What are they telling us when we're going out there face to face and now virtually talking to them about their plans, their concerns, and why they're offering a target date fund. And we take that all into consideration when developing our glide path and our asset allocation.
Thanks. It actually kind of leads in the next question that's come in, and it's along that vein as well. Kim talked about it a little bit earlier about managed accounts and that trend being one that continues to accelerate. So the question is T. Rowe Price, when it comes to target date funds, do you envision, or does T. Rowe Price see something there that might be like a target date that would begin to factor in other factors other than just age? Or what does kind of the future envision for you guys on the target date fund?
Yeah, that's a great question. And I caught the tail end of Kim's presentation and heard him talk about kind of the smart QDIA. And that's something that we're really taking a hard look at. And I think that there's some operational considerations with QDIAs or with managed accounts and kind of bolting them on to a target date fund. But I think the smart QDIA approach is likely going to be the one that will win out with many individuals, because what we find is that, the younger participants, the equity allocation, as Kim kind of mentioned, most target date fund providers, they're mainly equities, right? They're mostly invested in stocks. Growth, I think everyone agrees, for younger individuals is what you want to have happen. But also, kind of, even if an individual was saving a lot more than they needed to and maxing out their 401k from the beginning, and maybe from kind of a mathematical perspective didn't necessarily need to save as much, we find that a lot of individuals really aren't engaged with retirement until they get closer to retirement. So that's why we think that the smart QDIA approach, where you first take kind of a target date fund and then bolt on a managed account, or be able to offer a managed account solution. And then as individuals get closer to retirement and the likelihood that they want to be more engaged and will be more engaged in providing you with the information that you need to be able to build a more holistic asset allocation that's then customized to their specific needs and investment objectives, we think is really attractive and something that we are continuing to look at and are likely going to hear more from us in the coming years or so.
So, and maybe restating that, Andrew, it sounds like T. Rowe Price, as you look, the dynamic QDIA is a solution that you guys see as one that will continue to gain traction as it is.
Yep.
Is that fair to say?
Yeah, absolutely. We think that that's going to be kind of, don't want to call the winner just yet, but we think that it makes sense that smart dynamic QDIA is something that would be attractive for a plan sponsor to be able to offer their employees, because you tend to get more engagement. And that's what you need from a managed account, right? You need the engagement from the end user to give you the additional information that you need to be able to put that into the system to then develop a more custom asset allocation. So we think that it's kind of the best of both worlds. You can offer a target date fund for your younger employees, and then kind of a smart QDIA or a managed account as you continue, for your older employees as they start to approach retirement.
Okay. And then if we have time, Andrew, if we've got one more question, then we'll turn it back to Bill, and there might for some final comments, and even if there's a question or two for Bill. But the last question to come in here is with T. Rowe, obviously the T. Rowe Price and the glide path is you guys take I would probably say a greater approach to longevity risk, which means a little more growth oriented. And it's safe to say that the glide path is certainly not the most aggressive in the space, but it's on the more aggressive side. If
Sure.
in the next 6 months, or we see another big downturn by this pandemic or other factors, can you talk to, what type of concerns that you guys see, or how, as you guys build that product and look at it, of course, downside protection is also an element, but maybe talk to that just a little bit.
Yeah, absolutely. So kind of earlier when I was talking about our tactical positioning, that's another lever that we have to be able to kind of help to mitigate risk. So if we see and start getting concerned with storm clouds and kind of that there could be, really increased volatility on the horizon, we have the ability to reduce risk in the portfolio by taking down the equity allocation across the glide path. We can make very modest changes. So we can go plus or minus 5% relative to kind of where our strategic allocation is across the glide path. But that certainly, I think, is an important lever to understand that as an investment manager, we have the ability to de-risk portfolios automatically for clients and have that additional lever to pull. So not only do you kind of naturally de-risk with the glide path, we have the ability to tactically do that in addition to the glide path to be able to reduce risk if we think that volatility is likely to, or if an asset class, I should say, has gotten out ahead of itself and we want to reduce risk in the portfolio. And I think it's also important to note, and kind of what I said earlier, we don't want to minimize the emotional stress that volatility can have on individuals. I know firsthand, my mom is approaching retirement, and I think I fielded 2 to 3 phone calls from her a day during March, because of all of the concerns that she had with seeing her account balance go down, and really still trying to talk to her about everything that I'm talking about today. That really time in the market, stay invested, make sure you're saving enough, do all of the right things, and in the end, you're going to set yourself up to have the best chance at a successful retirement. So certainly don't want to minimize downside risk, but I think that there certainly are trade-offs, and that's what we talk to all of our clients about. If you want to mitigate longevity risk, and that is the number one risk that you're trying to mitigate, we believe that growth is your best friend to be able to do that. On the flip side is that your individuals will experience maybe a little bit more volatility, but I think you can take comfort in the data that we have and see from participant behavior perspective, they stay the course, right? Because the biggest concern from our standpoint is you see volatility, and you see individuals sell out at the exact wrong time, well, then they're not actually going to take advantage of that market recovery. And our modeling, that's what tells us will set them up for the best chance of success. So I would say that is an additional kind of point to take home, that individuals that are invested in a target date fund just aren't likely to trade. They're likely to stay invested and be able to take advantage of that market recovery when it happens.
Andrew, thank you for taking the time with us. It's been great to have you go into detail. I know for many of our plan sponsors, your target date series is the largest holding in their plan. We've spent significant time at Soltis with Andrew and the team at T. Rowe Price, and obviously there's a reason that we have a high level of conviction of how they've done this and how they do it. And I think we would say, Andrew, we're grateful for the good, strong performance. If at the end of the day, that's obviously one thing we're all looking for, and T. Rowe Price's historical and kind of year in and year out performance has always continued to be very, very strong, and we're appreciative of that. And so, Bill, let's turn the time to Bill for some final comments, and or if there's questions from those in the webinar that come to Bill Wallace, our Chief Investment Officer.
Thanks, Tyler. I guess I would just say, in summing up a lot of what we've talked about this morning, I think Soltis is really well positioned to move with how things are evolving in the space. We've been really pleased to see our client menus and the amounts of dollars that are going into target date funds, because we do believe that's a great place for the typical employee participant to be well served in their investments. But you can also see from what we've talked about today, managed accounts, collective investment trusts. These are areas that are forward thinking and very positive. And we've basically been working for the last 2 years to kind of be prepared for the coming of these events. And I think we are well prepared. So it's going to be exciting to see how managed accounts and collective investment trusts and these other things come here in the next year or two. So that's kind of where I'd stop. But is there any other questions, Tyler? Tyler, are you there? I think you're still on mute.
Sorry. Still, I am. So thank you, Bill. What we'll do right now is we've got just a couple of minutes. We actually thought we might have this. Dr. Eisenberg is actually finishing a speech, and he'll be ready for us in about 5 minutes. And so what we'll do right now is we'll just take a 5-minute break with everybody, give you a chance to stretch and catch up on some things for 5 minutes, and then Dr. Eisenberg will be on with us at 12:30, and we'll resume and go right into it as soon as he's able to join us and up and running. So again, Andrew, thank you for joining us today. Thank you as well, Bill. And we'll give everybody a quick 5-minute break, and we'll be right back with Dr. Eisenberg. you. All right. We're going to go ahead and get started. We appreciate Dr. Eisenberg joining us today. He's pulling a full day. He's just finished one speech and jumping on with us. So thank you, Dr. Eisenberg, for joining us. I'll just do a quick intro. We've got with all of our clients. So Dr. Eisenberg is an internationally acclaimed economist and public speaker. He received his BA in economics from McGill University in Montreal, and then has his master's and PhD from Syracuse University. So Dr. Eisenberg is a former senior economist with the National Association of Home Builders. He's also the creator of a multifamily stock index, which is one of the first ones to be recognized to track kind of the total return of public firms. And so with all that being said, what I would say is Dr. Eisenberg came to us very well referred and has a great ability, I think, to explain economics, which is not always the most exciting topics, but do so in a way that is and very much understandable. So Dr. Eisenberg, thank you for joining us today, and we'll turn the time over to you.
Thank you very much for that warm introduction. It's a pleasure to do this presentation. You know, you and I have spoken for so long, and we've had to postpone things because of the virus. It's nice that we're doing something now, and I look forward to hopefully seeing you guys in person down the road at some point. But let's begin by talking about what GDP is. Oh, I'm having trouble moving my slides again. Oh, I have to do something with my cursor. Oh, it's working now. Okay, let's begin by talking about what GDP is. Economists think of GDP in four parts: household consumption, C, the first term, where my cursor is. The second term is I, corporate investments in plant and equipment. The third term is G, government spending. And the last term is exports minus imports. I know it should be I minus E, but consonants, big consonants, are much more sexy than vowels. Fortunately for us, the sizes of these things, these four terms, are not the same. C is the biggest term in GDP. It's 68 or 69% of GDP. So it's the main driver. Prior to the onset of the recession, the coronavirus recession, C was basically all we had going for us. The problem was we were having trade wars with various countries. Manufacturing was weakening. So I wasn't doing so great. And G wasn't very fiscally stimulative. The fiscal stimulus that President Trump had passed in 17, by the end of 19 had waned sufficiently that it was effectively zero. It had boosted GDP growth a lot in 18, some in 19, and almost none in 20. So we were living on C. And then coronavirus comes and it cuts the legs out from underneath C, and our economy goes into a wild recession. And that's where we find ourselves now, getting out of this recession with C recovery. But we're going to look at C, then I, then G, then exports, labor markets, real estate, a whole bunch of stuff, and then we'll put it all together along the way. We'll put it together. Certain sectors of the economy are just spectacular. They're not good. They're spectacular. Here, for example, existing home sales. Marvelous. They're well above where they were prior to the onset of the recession. If you look at this graph, you can see here in 19, interest rates were cut by the Fed. They raised too much. They raised in 18 because they began to see some signs of inflation. And the central bank raised rates, killed the housing sector right there, lowered rates, it recovers dramatically and quickly. The recession comes, and then out of that housing demand becomes insatiable. People who were thinking of moving to the suburbs or to a single family house, a rental or a condo, did it. People who weren't so sure but had kids and didn't want to be locked in a little place with all their children and their husband or wife that they hate had to move. So there was a lot of movement and reorganization of lives based on states that were going to have schools open, based on backyards, a whole lot of things, but existing home sales are good. Economists don't care so much about existing home sales because there's not a lot of extra economic activity generated in that process. There's commissions to realtors, obviously, and loan officers and whatever, and there's renovations that go on, there's furniture that's bought and so on, but not nearly as stimulative as new homes. Look at new homes. Look at new homes. They're rocking it. This is unbelievable. there was a slow decade of improvement here from 2010 when they were terrible up to here. They were good. They go down in the recession, no surprise. And then they come out like gangbusters, absolutely gangbusters, but they've stopped. There's no more capacity. Land, labor, inputs, bottlenecks, unemployment rates among construction workers are back where they were before the pandemic began, despite massive increases in unemployment. It's really remarkable. So housing can't contribute to GDP anymore. It's done its share. It's done its part. It's over. Move it to the side. It will not improve GDP anymore. You can see they're stuck. Pending sales are slowing down. First-time mortgage apps, year over year, up 20% consistently, but they've been up 20% week over week for now a long time. So there's a new level, but the level's not going to grow. GDP will not get juice from housing anymore. This is all of housing. This is starts for single fam in red, multi-fam in blue, and overall in green. And you can see quite a difference in the story here. Single fam right now is above where it was just before the recession began. And where it was before the recession began was great. You can see this number where my cursor is. That was the best number in a decade. Weather was pleasant in the upper Midwest. Housing starts were really, really good. Then the recession comes and they come back like gangbusters. They're stronger now than they were then. Multifam, not so much. Multifam did well right before the recession starts, and then bam, stop. Because no one knows if they're going to pay rent or not. The fear of tenants not paying rent is palpable. And as long as tenants don't pay rent, who wants to build a new building right now? Unless you have extra cash, you can float the building for months while vacancy rates are high and you kick out tenants or whatever it is. Overall construction activity starts in green are pretty good. Not quite as strong as red, single fam, but stronger than blue, multi-fam. And single fam is 4/5 of the activity, right? You can see here. There's much more, 3/4, much more of it's red than blue. So all in all, housing is really good. No question about it. And it isn't the only sector that's really good. Other sectors are good too. Light vehicle sales, these are non-heavy trucks. The trucks weighing, 7 tons or more, not included. But then you have F-150 or 250 or a 350 or a Hemi from Chrysler or whatever, or a Chevy Tahoe or something, or Durango or whatever, or a Tacoma. They're doing well. They've recovered. Very good news. Very good news. But the good news ends because they're not going to help us out of the ditch anymore. We can't expect autos to help us much more. They've pretty much recovered. We will not expect housing to help us anymore. It has recovered. And another sector that's done really well is retail sales. They've come out of the chute well. They declined precipitously here. Huge decline, incredibly big decline. And it shoots right back up and then some. But these three indicators are all giving us false positive readings. I mean, it's true, the data's there. Housing sales are fantastic, and car sales are good, and retail sales are stupendous. No doubt about it. But under normal conditions, if I saw these three indicators doing this, I would go, wow, your economy must be on friggin' fire. But of course, it's not because of the pandemic. Car sales are good in part because people don't want to go by subway, bus, or train to work. Home sales are good because people don't want to live in a rental or condominium. And real retail sales are so good because we're not buying services. We're not going to La Manna. We're not getting a pedi. We're not going to a haircut. We're not going to a baseball game. We're not going to a football game. We're not going to a rock concert. We're not going to an opera. We're not going to a symphony orchestra. We're not going to a restaurant. We're not going to a bar. So you have all this money you used to spend on a monthly basis on these services, but now you don't. Well, you can spend more on retail sales. Buy more pants. Buy a Peloton. What the hell? You're not going to the gym because you may die. So we're buying goods. Goods includes houses, cars, and retail sales. But we're not buying services. And that's why our economy is in the ditch right now, because the other parts have recovered, but not that part. So these in isolation are giving you very false readings of how the economy is performing. And the other thing to see in this graph here, and a lot of other graphs I'll show you, is this trend. You see, we're good before the recession begins. Then the lockdown hits, we collapse. We get out of the lockdown, things are really good. And then we return to normal. So you see this up, And we were here, we crash, we come back up, we come back, and then we move to neutral long-term trend. That's where we are now. Real retail sales will grow by a normal 2% a year, 3%, whatever the normal is, it'll be. Car sales will grow by the normal amount because it is what it is. Housing sales are now done. They'll grow by a little bit as more people go into the industry. People age into home buying. But there's not going to be wild growth in these sectors because they've had their wild growth and now they're trending on their normal path because of this. This is the overarching thing going on in our economy. I cannot stress it enough. And it's something that I, as an economist, missed. And I feel bad about it. Maybe that's why I'm overcompensating now. Our economy is a two-speed economy. There's a goods economy and a services economy. And in services here, I mean close touch, like travel, tourism, restaurants, bars, cultural events, museums. They're not happening. Forced savings is taking place. If you invest in a sector where they're not spending because of this forced savings, like in services, just be careful. They'll improve eventually, 3 or 4 or 5 or 10 years from now, office buildings are going to be great. Whether it takes 2 years to recover or 10, I don't know. But goods are out of control good. Now they're going to weaken once the injection comes, sometime in spring or summer, and we'll return to our more normal paths. But there's going to be another round of upset as the drugs come and we return to something resembling normal. Will we go back there as like before? I don't know. There'll be some permanent changes in the economy. I am certain of that. But beware of where you're going. Things in the service space are cheaper. You want to buy a hotel? Well, they're much cheaper. You want to buy a factory? Not so much cheaper because they're going gangbusters in many cases. Why is our economy in this bizarre situation in the first place? Because of consumer sentiment, because of coronavirus. This is the University of Michigan Consumer Sentiment Index. There are other places that put it out. Bloomberg puts it out weekly, and the Conference Board puts it out monthly. Michigan puts it out bi-weekly. It's not a bad number. It declined quite considerably from 100 to 70, but now we're at 82. We've made up a third of the distance. We can't make it all up because coronavirus is out there and it's raging in general, right? This is the problem. This is the coronavirus situation. Not so good. Let's dissect this story. Blue lines are the number of tests done in a day in the US. Early on, back in March and April, we did very few tests, 100,000, 200,000 tests. We weren't testing enough. So we really didn't know what the population, what was going on. We had no idea. So people who were sick took a test, and we had very, very high rates of positive tests. Crazy high, right? 20% or something. That's crazy. It wasn't telling us much till we had a problem. How bad, we didn't know. Took more tests. Test numbers are going up. We get to 700,000, and number of incidents of positive tests go down. Great. Then they go back up. Then they go back down. And now they're going back up again. And states are having real problems. Until we get the virus under control, we can't get the economy on track. Sure, governors are closing things down, restaurants, bars, whatever, sporting events, cultural events, family meetings, under 10, under 100, under 50, whatever they are. You can't get the economy moving. Corporate travel is not going to happen. A lot of personal travel is not going to happen, and so on and so forth. So you've got some real issues here. The vaccine's going to come, but it's not going to come overnight and not going to solve our problems tomorrow morning. That's another important thing to keep in mind. Yeah, the vaccine's kind of ready for prime time, sort of maybe. They're going to get some expedited emergency use licenses once a couple more weeks have elapsed and they've checked the data. So by end of this month or early next month, they'll probably be able to start injecting people. The injection process takes 2 jabs in your knee, in your shoulder, weeks apart, with a 2-hour follow-up after each one. 2 hours. This is a long process. And the vaccine has to be stored, from what I understand, at minus 112 Fahrenheit, which is roughly minus 70 centigrade. That's a little colder than your refrigerator or freezer. So we have problems in delivery, we have problems in storage, and we have to do it twice, and it takes a long time. It's hours each time. This is not going to be an instantaneous process. The older people are going to get it first, and frontline workers are going to get it first. So healthcare, elderly. But until you and me get it, it's going to take a while. So our economy now is improving, but it faces some strong headwinds in raging coronavirus, fiscal stimulus weakening, and the election turmoil still continuing a little bit, even though we have a vaccine that we know will be available by spring and probably largely inoculated by the end of the year. But we still have a chunk of time between here and there. And the first person who gets it's not going to solve the problem. We're not going to have herd immunity right off the bat. So there's going to be some rough and tumble times. We're going to need fiscal stimulus to help us through here. Whether it comes or not remains to be seen. Because of this fear and because of working from home, because the virus is out there, large sectors of the economy haven't fundamentally improved fully. Houses have, much of manufacturing, but not all, has. Auto sales have, retail sales have, but there are just some, and those aren't going to help us anymore. They've done all they can do to help us. They've recovered. Now somebody else has to pick up the baton, another sector of the economy. But it can't be sports, it can't be cultural events, it can't be bars, it can't be restaurants. So we're stuck in this limbo. We've done what we can, but there's more we need to get done, but we can't. Once the vaccine comes, we can get there, but only if those firms exist when the vaccine comes. We want those restaurants to be viable, to increase their employment dramatically and quickly once the virus is beaten. But if all these restaurants go away, then we'll have a problem reconstituting restaurants. Unemployment will stay longer. Growth will weaken. Growth will grow more slowly. People won't have jobs. Here's another example. Travel activity. It's well down from what it was. So gasoline's at 90% roughly, right? This is roughly 90% of where we were before the vaccine. Cars are almost back up to normal. Retail sales is better. Housing is better. But travel, it's at a third, 40% of where we were. The blue, the dotted line in gray is the percentage of where we are now in red compared to where we were last year in blue. We're well behind. We can't get better. I don't want to get in an Uber. I don't want to walk through an airport. I don't want to board an airplane. I don't want to sit on an airplane with 300 of my best friends coughing all over me, get off the plane, go through the airport, get to Uber, go to a hotel with more people. It's people at every stretch of the imagination here. Not happening. Our economy can't improve until these sectors get back on track. And they can't get back on track because of the virus. Even though we know the virus is coming, I can still die next month waiting for the virus. Now, there's better treatments out there. Mortality rates have dropped dramatically. Tell that to my mother, who's 83, and my dad, who's 85. They're not interested in hearing the stats. They know if it comes for me, I'm going to die because the elderly have very high rates, mortality rates, right? Here's hotel occupancy. Business travel hasn't returned because businesses can't send their workers on travel because if they get sick, the worker will sue the business in many cases. Businesses don't want to take the risk. So Delta, American, and United, they just sit there doing pretty badly because they depend on business travel. By contrast, Southwest, JetBlue, and Frontier are doing much better because they rely on just plain old families going on vacation, and those numbers are improving. But look at hotel occupancy. You see some general stories that I've already talked about before. Massive decline, followed by a nice recovery. And then where my cursor is, the slope of the line changes. It goes from roughly this steep a slope to this steep. It's not that steep, it's this steep. The flatter the slope, the longer it takes for the recovery. And if the slope goes flat, like it is here, there's no recovery. And if it goes down, we're declining again. Now, it's declining because it's late in the year and there's less corporate travel, even regularly. You can look here at 18 and 19, the blue and the black, and the 20-year average in over here. You can see this time of year, things are much weaker, right? So the fact there's decline now is we don't know if it's because of coronavirus worsening or just regular seasonal effects. But we know that restaurants and hotels are done for the foreseeable future. How about Las Vegas? Are we going to go to Vegas and have a good time? Probably not. Too many people again. Got to get the Uber, airport, airplane, reverse process, hotel, walking along the strip there. Whoa, that's a little risky. A lot of people. That said, it's improving like airline travel. To go back here, airline travel is steadily improving. People learn to live with it. They wear goggles, they wear a gas mask, they get some death insurance, whatever. They feel better. Vegas is similar. Convention attendance last year in blue, blue dotted, this year in yellow dotted, is in the garbage can. 0. But households going on vacation, flying Frontier, JetBlue, and Southwest are doing immeasurably better. They're, at some reasonable number here, 1.5 million or something, whatever, down from 3 or 3.5 million, but it's still making progress. But it's getting better, but it's still, we're not even halfway there on the household side, let alone the conventioneers that are bringing in 600,000, 700,000 a month. They're again 0. So Vegas is at 30, 35% of occupancy. They're really struggling. That's a huge sector of the economy. Orlando really suffering. Miami really suffering. These sectors, Miami less than Orlando, but Orlando suffering. How about Orange County, California, where Disneyland is? That part of Orange, they're suffering too. Six Flags and all the dolphin things, they're also suffering. Job postings have improved, but the rate of improvement is slowing. I've talked about the rate of improvement slowing here. I've talked about it also, importantly, here. And in cars and autos and houses, it's back on the axis. It's flat on the axis. Huge decline, huge improvement, and then back to normal. You see this over and over and over again. So here you see a very steep slope through there, through August 1st, nice steep slope. But after August 1st, the slope goes from here to there. This slope here on the right hand is much less steep than this. If we take this slope and extrapolate it forward, we'd get to there and our troubles would almost be over. But we can't because we still got coronavirus, even though we know a vaccine's going to come in July for the vast, or May or June or April or whatever. And there'll be more companies. Moderna's going to come with one and Johnson & Johnson's going to come with one. It goes on and on, right? There's going to be a bunch of them out there. So we'll have vaccine relief, but we got to get there. That's the issue. Public transit usage, nice improvement out of the lockdown, then less improvement, and now no improvement. Those who are taking public transit have decided to take it. But a lot of folks are saying, no, I'm going to work from home. I'm going to take a car, or I'll carpool with 2 of my best friends who don't get out of their bubble either. So there's a bunch of solutions to this, but public transit's not helping us here, right? Lots of sectors aren't doing their part, if you will, not literally doing their part, but you get the idea. Now, you put all this together, all personal consumption, you can see what's happening. It collapses precipitously, comes back quickly, but then it starts to fade a little bit. And as the slope tilts down, that means the rate of recovery is slowing. And that's the problem that we encounter going forward. Our recovery is weakening because the sectors that have improved are done. And the ones that haven't improved are ones that are very hard to get better. Restaurants can't serve the number of meals they did. There's no way. We can do takeout, but that's not the same employment boost to the economy that a sit-down meal is. You got waiters and waitresses and maitre d's and hostesses and so on and so forth, and general managers and so on. With takeout, it's a whole new business. Restaurant can survive, but employment's much lower. And all these firms are doing all that stuff, but they've done it. They can't do more right now. They have to wait for the vaccine to come and the virus to largely go away. And you can see the same trend here with overall household spending. It collapses during the recession. You can see it there in early 2020. It comes back like a rocket, and then it slows down and trends back to normal. 1 or 2 more months, and there'll be no month-over-month change at all because we'll have done what we did. We've gone from services to goods. We're buying lots of goods, but we can't keep buying more and more goods. It's done. We bought a car. We bought a Peloton. We bought a recreational vehicle. We bought a kayak. What else is there to do? That's the issue we're running into now. We're shopped out on goods, right? At some point. Manufacturing is a different story. Manufacturing is doing quite well. It hasn't recovered, and it can't possibly recover until we've recovered because all the manufacturing gearing to those sectors of the economy that aren't working aren't manufacturing stuff. You can imagine a company that only sells sheets to restaurants, tablecloths to restaurants and sheets to hotels. Well, they're not very busy right now because Restaurants and hotels aren't doing very well. That said, if you ask manufacturers how you feel, not how busy you are, but how you feel in this graph, the Institute of Supply Management asks purchasing managers how you feel. They feel pretty good. They're happy. Manufacturing's doing well. It's recovered a lot, not all the way, but recovered a lot. And it's busy, 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 busy. With some sectors, not busy at all. Imagine the place that's selling napkins, again, to a football stadium, or relish to a hockey arena. You know, ballet slippers to ballerinas. It's not happening. So it's a two-step recovery. Factory utilization rates, they're not so high. You can see they were here at 110. It's an index number. The number's meaningless. It falls to 90 roughly, and now it's a little over 100. We've made up, 60% of the loss, but there's still a bunch left to do because these sectors of the economy can't get on track because coronavirus is here, inhibiting us from doing things that we would normally otherwise do. Now, but firms are doing a lot of investment in plants. So this prior graph here, firms aren't going to invest in plants here, no plants, because your plant isn't being fully utilized. But we can invest in equipment. We have to invest in equipment. We have to get our customers back in the store. We're a bakery. We have to figure out a way to sell you a loaf of bread without you coming in with $5 and getting cash and getting change and all that bad stuff. That's not going to work. How do we get you in? Wow. How about direct paying? Pay on credit card, have a phone app, whatever it takes. And then we're going to email you a receipt. You'll bring the receipt to a window. You'll wait outside and we'll give you a loaf of bread. That costs money. How about you have face-to-face contact at a hotel? We'll put a plexiglass sheet between you and their hotel side. We can think of all kinds of solutions to problems, but they cost money and they're happening in spades in this graph on the far right. But we're investing a lot less in plants. There's employment growth here because of the virus. It's helping, but it's not nearly as much help as building plant. Equipment's good. We need plant, we need equipment, but we also need plant. And the plants, by and large, not coming. There are big exceptions. Amazon, logistics, cell towers, but overall. And energy is not helping us either, right? So in Utah, you've got the Uinta Basin, right? There's lots of energy going on there, except there isn't, because oil prices in the ground and natural gas prices pretty low too, and based almost exclusively on weather patterns. Things aren't happening there either. So energy is not going to help us. Are firms going to give us lots of money in share buybacks and dividends? Not so much. Banks are precluded from giving dividends. The central bank has held them back. So this is part of the reason share buybacks are quite weak. And dividends are down a bit because firms are saying, I better hold on to my money. I don't know what's going to be down the road. How long will this last? Now we know at least the vaccine's coming. That's new recent information. But heretofore, we didn't even know that. And in terms of firms, how bad will it be? We don't know when people will come back, even after the vaccine. Like, how quick am I going to be to want to go to a rock concert, for example, and hang out in the mosh pit with thousands of my closest friends breathing and coughing on me? Even with the injection, I'm not, because the injection's not going to be 100% either. It's 90%. That means some people are still going to get infected. So there's still a risk you're incurring. How happy are banks? Banks aren't terribly happy. Bank stocks are doing terribly, just terribly. The Keefe, Bruyette, and Woods stock index for banks, it improved with the vaccine because firms are going to do more investing now and stuff, and they'll borrow more money and returns will be better. And people will go back to the office and more people will get paid and unemployment will fall. That's all good. But in the short run, not so hot. Banks' net interest margin, the profit they make on a loan, their gross profit, if you will, for other industries, the amount that the price they lend money at's here, the price they borrow at's here, that gap is called net interest margin. It's declined precipitously. You can see it in the graph right here. Blue is all banks. Black is the bigger banks, not even the biggest ones, just the bigger ones. 15 billion, not so big. That includes, Chase and all those big ones, and Goldman, which are more of an investment bank. But their net interest margins weakens dramatically. So their urge to make a loans decline, and the credit quality of the borrowers has declined because of coronavirus. A barber comes in and says, hey, I want to buy more combs, or how about some new chairs that turn around? Bank goes, Your sales are really rotten because no one wants to take a risk and get coronavirus while getting their hair cut. I'm not lending you the money. So banks are struggling with making loans and making profit, both. Not an enviable situation. And the general problem here is, as I mentioned, forced savings. We're buying goods, we're not buying services. We're saving money because we're not buying goods. And on top of that, the government sent out checks, $1,200 checks to adults, $500 checks for the kids, to the parents, but for the kids, unemployment checks of $600 a week extra. All this money, some of it went to pay credit cards down, some went to mortgages, some got saved. Savings are very high. Being in a sector where there's forced savings has not been very profitable at all. What we saw in the stock market earlier that last week, I guess, when Pfizer announced that the vaccine was coming, was the NASDAQ declined, whereas the Standard & Poor's and the Dow went up. This was a reversal of this trade. The sectors that had been suffering because of the forced savings now know that in 6 or 7 months, it's going to end. Cruise lines, a year from now will be fine. If you've had an injection, we'll let you on the boat. I'm sure they'll want to see proof of the injection or something, but they'll let you on the boat. So we know things are going to get better because the forced savings is going to go down. But if you invest in something in forced savings, you've got to be prepared to hold on for another 6 or 7 or 8 months. We don't know how long it'll be until herd immunity is achieved, right? That's why we need fiscal stimulus going forward. We really do. There's problems with fiscal stimulus. It hurts the deficit, as you can see here. But without it, unemployment insurance payments monthly keep declining. People who don't get this money are going to lose their apartment. They're going to be evicted. The landlord's not going to be happy. Spending will decline because of the landlord and the tenants, and it will metastasize. No, it won't be immense, but it will hurt GDP growth, maybe cause employment growth to decline a little bit until the vaccine comes. This wouldn't be calamitous disaster, but it's what you want to avoid. You want to have all systems go such that when the economy turns around, restaurants can start hiring, airlines can start doing things, and it's worth the money. I think a well-tailored $1 trillion would get us through to the end of till the vaccine's out in a big way. Less focused, $1.25 trillion, $1.5 trillion. We'll talk politics in a second about what's going to happen or what I think will happen and why going forward. But this money, now it's true, it raises the deficit and it discourages work ethic among people who get the money. I understand that too. That said, what's the alternative? I keep asking, people ask me, Elliot, how are you? And I say, compared to what? These may be bad outcomes, less desire to work because you're getting the money and worse for the debt and deficit. I understand that. But what else are you going to do? Give me a solution. I'll think about it, right? And the dollar, in terms of exports, the dollar's decline. That's altogether a helpful thing. There's no question about it. But we don't export a lot of stuff. We used to export a lot of airplanes, but Boeing single-handedly solved that problem conveniently. I do. We export lots of services. People come here for vacation, but they're not coming because of COVID. Foreigners come here to go to school, but that's not happening because of COVID. We export movies that are shown in movie theaters, and our movie companies get royalties, but that's not happening. So what we're good at exporting isn't happening, and what the services that we're good at exporting aren't happening because of coronavirus. So our trade deficit's getting worse, and we have an ongoing trade war with China, and that trade war is not going to change with Biden in the White House. I think he will keep the heat on China. Trump elevated our awareness of that problem. And I think it's now in our collective unconscious to stay for quite some time. When you put all this together, what you end up is GDP looking like this. Q1 declined by 5% if Q1 lasted 12 months, only lasted 3. So you divide roughly by a quarter. There's compounding, but we can forget that. So 1.25% down there. Q2 declined by 30%, which is 7.5%. Q3 went up by roughly 30%, so positive 7.5. And Q4 will be about 4% or 5%, maybe 5%. Now, Q2 and Q3 look offsetting, but they're not offsetting. Q2 declined by 31 to 32, and Q3 increased by 31 or 32. But the math here is very oppressive. If you're at 100 and you fall by 30%, you're down to 70. At 70, if you go up by 30%, you're up to 91. You're at 100. You fell by 30, you're up by 30, you're at 91, right? The guys at Soltis will explain that to you over and over again, and I'm sure they have, right? So our economy finds itself in a hole. Q4 will be okay. You know, with stimulus, it could be 9 or 10% growth, but we're not going to get any stimulus. If you get it, it won't help us until Q1 21 anyways at this point. So it's helpful, but not for Q4, right? What does the recovery look like? Like a check mark. A bad Q1, terrible Q2, a great Q3, and then a slow friggin' slog. And now we're in the slow slog. There's no magic here. We can't get restaurants to open very quickly. We can't get cultural institutions. You know, given enough time and years, we'd re-engineer all these processes to make them work. But we don't have the time to do that. And we know in 7 or 8 months, the vaccine will come. But between now and then, we got a problem on our hands. Winter's coming. Coronavirus is worse. Fiscal stimulus is declining. Right? These are headwinds to our economy, despite the tailwinds we've received in fiscal stimulus in the past and the drug that we know is coming, and along with more drugs. This monoclonal approach taken by Pfizer and BioNTech is a good one. It seems to work, and there are other approaches. Moderna is using the same approach, and these drugs can be re-engineered as the virus mutates as well. So it gives us flexibility as a society. These are good things, but not today. It'll be tomorrow. Let's talk about labor markets. They were very tight. They're not so tight anymore. So here you can see labor markets with 150 million jobs down to roughly 130. We lost actually 22 million jobs. We've made up about 12 million jobs. So unbearable losses, spectacular recovery, and yet still a huge decline to be made up. And the problem is, you can see in the employment situation, the curve is curving out. It's not curving up so much now. It's now starting to curve out. That's a problem. That means the labor market recovery is slowing. It hasn't stalled yet, but it's slowing. Months so far, job growth has been pretty good. It was 4.5, and 2.5, and 1.5, and 700,000. Last month it was a little less, but because of census workers who lost their jobs, it's been really quite good. I'm amazingly happy with the progress that we've made. But even at 500,000 jobs, to make up 10 million jobs will take us almost 2 years. So there's still a ways to go. GDP might come back in a year, but the labor markets are going to take 2, maybe 3 years. And the other thing we've learned, because a lot of firms have fired a lot of workers. Restaurants have fired tons of workers. They're not bringing them all back. They might have a guy like Tyler on their staff. And they say, Tyler's nice. You know, he's good looking enough. He tells funny jokes. He doesn't work. He doesn't clean up after himself. We're not going to rehire him. We don't need him. So a lot of firms have had this extreme experiment, and they've learned they can do better with less or as much with fewer than they have before. So I don't see employment recovering nearly as quickly as GDP. We'll make as many meals as we did, but we'll do it with fewer employees. Now, unemployment's come down dramatically. It's fallen from technically 14.9 down to 6.9. It was actually more like 19.9, but there was a misclassification in the Bureau of Labor Statistics data. They disclosed it. There was no hiding it, but they erred for 3 or 4 months in a row. And that error now has pretty much gone to zero over time. The gap between what really is and what they reported has been shrinking. They've reported all the numbers. They just misclassified workers, and they've told us about it. This number, like the auto sales and retail sales and housing sales, is terrific, but it's artificially good, the unemployment rate. And that's because of declines in the labor force participation rate. People drop out of the labor force. They stop looking for work. If you aren't looking for work, you're not considered unemployed because you're not looking. If you look at all the prior recessions, the double dip recessions of the 80s here, the 1990 recession that we experienced, the 2000 dot-com bust recession, and the global financial crisis of 2006, 7, 8, 9, or whatever you want to call it. There were some declines in labor force participation rates here, there, sure, there was more. There almost nothing there, nothing there. But nothing like we see now for men, for women in red, and overall in black. This decline, these people who've dropped out of labor force aren't considered unemployed. If you took our labor force number and brought it back up to where it was, it would raise the unemployment rate by about 1.5 percentage points and go from roughly 7 to roughly 8.5. That's quite high. It peaked out at 10 in the global financial crisis. And worse, If you look at the number for women, it declined like it did for men on top. It went up like it did for men over here, but men kept going up. And how about women? They're declining because they're staying home with junior. If kids don't go to school, a large percentage of women don't go to work. The kids suffer with subpar education, and the women suffer because their careers are cut short or stymied or delayed, and they're not making money, and their employers suffer. It's a bad, 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 bad outcome. So the unemployment numbers are true, but they're a little bit misleading because of the situation that we're in. And we still have very high first-time claims for unemployment. Before this recession began, unemployment, first-time claims for unemployment were about 200,000 a week. An economy is doing well if you have 300,000 first-time claims or less a week. That's like 1.35 million a month. And you create 1.5 million new jobs, and you have net new jobs of 200,000, and things are great. The highest number this number ever showed, this first-time claims for unemployment, prior to the onset of this recession, was 695,000. And that was in 1982. And then the worst week of the recession, it hit 7 million. The following week, 6.5 million. We lost 13.5 million jobs in 2 weeks. Heretofore, the worst a week was 695,000. Right now, data came out this morning, not on the graph, it was 705,000. So now after 29 weeks of this recession, or 30 weeks, or whatever it is, we're just slightly above the prior all-time 50 or 60-year high. That's how high first-time claims remain. It's hard to create new jobs when you're losing so many. That's the problem we face too. So our economy continues to improve. These numbers continue to go down. They go down faster with the stimulus package, and they go down much faster to get the vaccine onto the market more quickly. So the recession's is checkmark shaped, as I mentioned, right? Down in Q1, much worse in Q2, pretty good in Q3, and then slow slogging for years to get back to recovery. Unemployment's going to take longer, but it depends who you are. This recovery is also K-shaped. It's checkmark shaped and it's K-shaped. K because a lot of people on the top part of the K, they're doing fine. They're working at work because there's no problem, or they're working from home because there's no problem. But if you're a frontline worker, you're a bus driver, you shine shoes for a living, you sell pants in a store for a living, you don't have a job. These are younger, less educated people. They've taken it on the chin. Sectors that employ them have been hit hard. Restaurants, Chuck E. Cheese, these places can't survive. They lay off their workers. Those workers tend to have less education. Look at this graph. You can see those with a college degree, where my cursor is, their unemployment rate's pretty low. Those with some college or an associate's degree, it's higher, but not all that bad. But you get to just a high school or less than high school in blue, it's a calamity. These are the people that will be very adversely affected if we don't get stimulus. They'll be evicted from their apartments, and then it's a whole cascading problem in many cases. They're homeless, the kids don't go to school, and on and on and on. This becomes a very expensive and bad outcome for society. In terms of inflation, forget about it. There isn't any inflation. Don't worry. Don't worry. This is PCE, what the Fed considers inflation. They don't look at the CPI, they look at the PCE. PCE, like the CPI, has many measures of inflation. The two key ones, or two of the critical ones, are overall headline inflation in blue and core in red. Core takes out food and energy. Food and energy aren't all that important because they bounce around a lot because of war and drought. Drought or a flood, and agriculture is terrible. A war, oil prices skyrocket. Those are important, they matter, but they don't give you the underlying inflationary tendencies or pressures or mojo in the economy. So economists look at the red to give you the basic feeling. Is red going up? Yeah, it's going up. From a ridiculously low level that we've almost never seen except coming out of a recession in 2009, and then a bad spot in 2010. This is the lowest level, 4 or 5 months, it was the lowest level we've seen PC inflation in 20 years. 20 years. So it's up from there. Big surprise, no big deal. Will it go much higher? How? Unemployment is high, factorization rates are low. Look at China. They've recovered. They have inflation? No. Japan, they wore masks, very low levels of coronavirus, no inflation. Taiwan, great measures of success battling corona, no inflation. So we had no inflation coming into this recession with unemployment at a 50-year low at 3.5%. No inflation. Hard for me to see inflation coming now. Yeah, a little bit here and there, some bottlenecks in making pork chops and diapers. But beyond that, I just don't see it. Without inflation, hard to get interest rates up, hard to get the Fed to move. Now, some people say, Elliot, look, the money stock's going up. The Fed's trying to push the money stock out there to get inflation. Yeah, so what? Big deal. The money stock is only half the story. The other half is monetary velocity. There isn't any monetary velocity. There's none. If the money is entering the economy, but the money's not being spent or being used, there's nothing going on, right? So the money may be being pushed out there. An environment may be being created by the central bank that encourages borrowing to go on and banks to lend and create money. But until this turns around and goes way back up, just forget about it. So the Fed can keep interest rates low for as long as they pretty much want. Do you see inflation and tendencies here? No, there's nothing going on. Nothing going on. And the Fed's changed their inflationary mojo. The Fed used to say we're going to raise rates when unemployment falls because low unemployment leads to higher wage growth, and that leads to inflation. Now the Fed says, we're giving up on that. We're not going to raise interest rates until we see inflation, not the leading signs of it with unemployment falling, or even wages going up. That's not going to cause them to raise interest rates either. It's going to be the actual inflation. It's going to take a long time for inflation. Quickly on politics now. On politics, this is the most important graph. Red dotted is where we are now. The White House is controlled by Republicans. The Senate is Republican and the House is Democratic. We are going to move minimally to blue, or most likely to blue. That's going to be a Democrat in the White House, the House remaining Democratic, and the Senate remaining Republican. There's an outside chance, however, that the Senate turns Republican, Democratic. Democrats get both chambers, flip the House, they flip the Senate, they flip the White House, and they keep the House, right? Flip the Senate, flip the White House and keep the House. That would be a more stimulative environment. But there's a big caveat. The big caveat is the majority in the Senate Democrats will be exactly one. If they win the 2 Georgia runoff elections in early January, they'll have 50 seats. The Republicans will have 50, and Kamala Harris will come to the Senate to break ties. It's hard to ram through a lot of big legislation with a majority of one. Moreover, one senator in the entire Democratic caucus can say, nah, not happening, and the whole thing dies. So it's very hard to imagine massive amounts of stuff going through under these situations with the Democrats holding the Senate by 1 seat, if they're lucky enough, and holding the House by, their majority was 227 to 203 or something like that. I think it falls by 4 or 5 seats. So the Republicans and majorities narrowed there. So it's going to be a little hard for Nancy Pelosi and Chuck Schumer to hold their caucus together. It'll be very fractious because just a few people leaving in the House or one leaving in the Senate can kill everything. So the compromise will have to be extreme within the caucus, making massive wild events and big tax increases, huge spending increases, remarkably unlikely. Let's wrap up by looking at 2 or 3 slides about what local conditions are around the country, and then we can take questions for a couple of minutes. This is economic data through August. And economic data filters in months late. So you don't get the August data until September or even October in some cases. So it can take months to get a clear view of what went on in August. But here we have the clear view of August. The darker the color blue, the better. So Michigan was improving rapidly because of auto sales. That's what's going on there. New Mexico stinks because the energy prices are very low, right? Let's move forward 1 month. Look at the overall color palette, the shadows here. It's lighter, darker, lighter. Now you're going for an eye test. Tell me, don't tell me whether the E is up or down or sideways. Tell me lighter or darker. Darker, lighter. That's the problem we face. The economy is growing, but it's growing increasingly slowly because of the headwinds of lack of money in the lower income households that are working in service sector economies because they're young or inexperienced, immigrants who don't speak English, or whatever, right? Coronavirus isn't here. Fiscal stimulus is weakening. And we have winter coming in, Corona's getting worse. So the restaurants that were able to seat 25% of their patrons outside won't be able to do that. I don't believe in Boston we're going to be able to do that in the middle of winter. It's going to be cold. Bernie Sanders may love to do things, but he doesn't do a lot outside in short sleeve shirts in the middle of winter. In Utah, it's a little hard. Even in places that are warm, like Miami or something, you can do it, but not every day. So it gets harder, right? Where are states growing the fastest? If I were opening a business, I'd be opening it in Texas, Florida, Arizona, North Carolina, because lots of people are moving there. It'll be easy to get market share. I'll also be moving to Idaho and Nevada, because those are having very rapid percentage gains in population, even if the numbers aren't all that huge, right? And last but not least, you've always got to keep in mind some overarching secular trends that are going through our economy. And what do we see here is people are moving south. Generally, there are exceptions. Washington, Oregon, Idaho are exceptions. But beyond that, if you draw a line from Washington, D.C., where my cursor is, to San Francisco, right around there, almost every state that's growing is at or below, on or below that line. Nevada, Utah are on the line. Colorado is largely below, and the other ones are below. On the East Coast, it's the Carolinas, Georgia, and specifically Florida, with honorable mention to VA and Tennessee. West to the Mississippi, which is pretty much here, it's Texas all the way through Idaho. Colorado, Arizona, Utah, Nevada, Idaho are doing great. Oregon and Washington less so, but doing well. But they're going to slow down because Portland and Seattle are very expensive towns. California is there only because early in the decade there was still growth, but that ended. It's over. California stopped growing. You can see it right here. California couldn't even get 50,000 people to move into their state or grow. Total population growth, burst over deaths and immigration, couldn't get 50,000 because it's too expensive. Taxes are too high. Home prices are too high. Traffic is bad. There's no air conditioning because Pacific Gas and Electric has to turn off the power all the time. And they have forest fires 12 months of the year. Who on earth wants to live there? And I was born there, so I can say these things, right? So, man, I hope I've given you some food for thought. I've taken up much too much of your time. But to be brief, C is probably going to weaken a little bit over the next 4, 5, 6, 7, 8 months until the vaccine comes out. I'd like to have some fiscal stimulus. The stimulus will worsen the deficit. It may make labor markets a little tighter because people don't want to work if they're getting so much money. It's still worth doing it. The economy will improve. Q4, 4.5, maybe 5% growth. Next year, overall, about 4% growth. It depends on how the virus goes and if we get fiscal stimulus, maybe 5%, something like that. Inflation, nothing to worry about. Interest rates, they're not going anywhere because inflation is not going anywhere. I put out every day 70 words on economics. No graphs, no ads, no charts, no links, and no photos. If you want to hear from me every day, think hard about that. You can get it by emailing me at elliot@graphsandlaughs.net. You can go to my website, Econ70, and sign up 70 words a day, Econ70. Or easier still, you can take your phone that you love and text the word bow tie, BOWTIE, one word, no hyphen, no space, to the 5-digit number 22828. Not even 10 digits, just 5. You'll be prompted for an email address. You'll hear from me every day until you die. I hope I've given you some food for thought and given you a way to think about the economy, which sectors are doing well and which ones are doing less well, why, and how things will go forward. It's been a pleasure speaking to you. I truly hope the next time is in person in beautiful St. George.
Dr. Eisenberg, thank you for taking the time with us today. We appreciate your insights and your expertise and your energy. And,
thank you.
And personally, I'm pretty sure that there's a few at Soltis that probably agree with your assessment of me that if they hadn't kept me around through this, I may not be able to stick around. But
I'm glad you were listening.
As of today, my key card still works. So
You're lucky. Consider yourself very fortunate.
Thank you, Dr. Eisenberg, for the time today, and again for joining us.
You bet.
We want to say thank you to each of you. We know that we've taken a good chunk of your day. We hope that that with the content today and the things that we've covered, it's been helpful and insightful. As we mentioned at the beginning of this, we've recorded this session, and we'll work to make that available here in the next week and send it out. For those of you that submitted questions that we weren't able to get to, we promise that we will do our best to gather those and circle back with you to answer them. And again, for any of those that have CPE credits, please email Tucker Morin at Soltis Advisors, just Tucker at soltisadvisors.com, and we'll get that submitted right there. And just the last thing to mention here is in absence of our conference this year, each year, as you all know, we typically we'll take and look at all of the plans that we are fiduciaries on and help measure and look at the progress. We weren't able to go through that in April. We are working to finalize that right now. And so here between now and the end of the year, your Soltis team will be reaching out to you we've done that work, and we've had great progress even despite a tough year in 2020. But there's been much progress and much recognition to be done in this past year for great improvement that we've seen in plans. So we'll be reaching out to you on an individual basis with that info as well. And again, thank you for spending the time with us today, for taking the amount of time that you have. And we again thank Dr. Eisenberg and Andrew Kuhn from T. Rowe Price and the Soltis team that have helped kind of put this together. We'll circle back with you, and thanks everybody for joining us. We hope you have a great remainder of your week.